Open. A minute to go until the start of cash equities trading. I'm Anna Edwards, live in London. Here are your top stories. The bulls roar back. Global stocks rally amid robust earnings optimism. The S&P 500 posts its best day since March. Goldman Sachs rounds out the week for US bank earnings after a surge in pandemic deal-making for rival US lenders. And European car sales are the weakest since 1995 in the month of September as the chip crunch takes its toll. Good morning, everybody. Welcome back to the European Market Open. Just 20 seconds or so to go until the start of the European equity trading session. Let's have a look at these futures. Surrounded by green this morning, we've got futures pointing to the upside, not by an enormous amount, but coming off yesterday's gains in the United States as well, gains through the Asia session. It seems that the earnings story is providing a positive narrative so far for global equity markets to head that little bit higher. Let's have a look at where these European equity markets are opening up then. We'll probably have to wait a little while to get all of them in full swing, but the FTSE 100 opening just a fraction to the upside. We're waiting, as I say, for some of the other markets to come to play. We have had a big focus on the auto sector this morning, a focus on the auto sector this morning. We'll see whether we get any big movement there. A focus on Spanish utilities. And look, I see the Spanish IBEX is up by 0.4%, so that's something we'll keep an eye on. We're also focused on inflation this week, as we've learned a lot more about inflation with the US CPI number, the PPI number actually, not coming with quite the same sticker shock, if you like, when it comes to factory gate inflation. Just seeing the French market opening up by 0.4%. Let's move on through the sectors picture. Energy, utilities, banks and technology. We've got energy stocks moving to the upside. And we do see, as Mark was saying just at the end of the last hour, we do see those oil prices just ticking gently higher the last couple of days, moving quite confidently, I suppose, in that direction. Not maybe with the same drama as we've seen on other days, but they are moving higher, and that is good for these energy stocks. Utilities up by 0.3%. Maybe there's some of those Spanish names in the mix there. Banks also higher. We have seen a bit of a flattening of the yield curve. Maybe the banks like the higher yield curve, but we've had some good banking results out in the United States, suggesting that lending is, in some cases, maybe the earnings season gave a shaky start in that regard, but in some cases we are seeing lending coming back, card transactions coming back, and of course the M&A story continues from earlier on this year. Technology up by 0.75% this morning. So European equity markets opening to the upside. So it seems the equity bulls are out of hiding and back buying the dip. The S&P 500 posted its best day since March yesterday, with a range of macro factors adding to investor sentiment. We had some robust earnings reports as well as a drop in initial jobless claims. Let's get to Emmanuel Cao, Head of European Equity Strategy, who joins us now from Barclays. Emmanuel, good morning to you. Thank you so much for joining us this Friday morning. Let me just ask you then about your convictions around European equities at this point. We see European stocks doing okay this morning. The overall picture is one of buoyancy, one where the bulls are back in control. Are you convinced by a further rally in European or global stocks?
Yeah, good morning, Hannah. Thanks for having me. Yeah, our conviction is that the market will keep climbing a wall of worry. We are getting to a more mature phase of the cycle. We are getting to an environment where equities are more expensive. A lot of good news are in the price. But look, at the end of the day, we think the expansion has more to go. We think the economy will keep growing enough for earnings to support equities and to defend their valuation in the backdrop of higher rate and higher inflation. So yes, we think the market can continue to focus on the positive. We think there are enough positive out there for the market to perform. And to some extent, I think the most recent consolidation is very healthy because there is no complacency. Investors are very aware of the risk. And I don't think the market is maybe as priced for perfection as it was maybe earlier in the year.
Do you fear that higher rates and inflation might be a negative for global stocks then, or that margins might feel the pressure if companies are not able to pass on those higher prices in the shape of price inflation? Do you think that the inflation narrative could come back to damage some of the stocks you're following?
Well, I think we might be at peak stagflation fears to some extent, where there is obviously evidence that growth is slowing and inflation is rising, but this is just a temporary imbalance between supply and demand in our view. And I do expect the Q3 reporting season to reconnect the market with fundamentals. And at the end of the day, we will see, I think, a more mixed delivery from companies. We're going to see less growth. We're going to see more companies talking about higher cost or supply disruption. But I think the pricing and demand environment should still prevail and ultimately help companies to shrug off some of these margin concerns. So some sectors will be more impacted than the others, but I think overall we are still having an economy which is growing well above potential, where demand is very strong, where pricing power is strong as well. So that should help most of the companies to mitigate the cost inflation and the impact on margins.
Okay, that's interesting, Emmanuel. So you believe they'll have the pricing power, they'll have those margins that they can, and pricing power should prevail in your words. So in terms of the sectors where this is going to fall the hardest and the lightest, where are you expecting to see real resilience? Where will those margins really hold up?
Well, we are quite positive on consumer discretionary. So this is where we think consumers want to spend and can absorb some price increases. So, we like the auto sector, we like the luxury goods sectors, we like the leisure sector. So we like the broader reopening theme as a way to catch spending by consumer. We like financials. We think, banks are not only about rates, they are also about lending growth. They are about, a stronger economy which can borrow more, and banks will be able to monetize the more reflationary economy. We like energy stocks very much. They had a very strong run recently, but we think the market is finally warming up to the much better fundamentals of the sector with, very strong ability to generate cash flow, very strong ability to grow and benefit from higher oil prices. So we are selective. We are a bit more nervous about miners. We are a bit more nervous about some of the capital good names, which maybe have less pricing power and are a bit more exposed to weaker Chinese demand. But overall, we think the cyclicals and the value sector is where you're going to see earnings trends, this season.
Okay, so I was just about to ask you, where the nervousness would fall around the Chinese growth story, and you mentioned miners and capital goods, so that's good to know. Let me ask you about what you call over-earning. Have we come off a period, Emmanuel, where you saw companies earning more than they should, or more than was explainable? What did it mean that we saw companies over-earning in the last quarter?
Well, we had 12 months of extraordinary rebound in corporate profitability, with a much stronger than expected rebound in global demand, and to some extent, a lot of the cost, subsidized by government policies, by fiscal support. So you had a very strong rebound in profitability, with obviously very depressed base effect that helped delivering impressive numbers. And now we are simply getting to a more normal environment where the base effect are obviously getting less favorable. Top line conditions are normalizing. Most of the top line, macro indicators have already rebounded. And as you said, rightly, Anna, the costs are starting to go up as well, right? So you're going to see less, impressive numbers, I think, coming out. But still, we do believe that earnings can grow double digit, and margins can remain relatively high. So I think the market needs to get used to less impressive numbers, but can still ultimately be supported by, fairly resilient earnings fundamental with, top line and margins both contributing to healthy earnings delivery.
Emmanuel, thanks so much for joining us. Have a good Friday. Have a good weekend. Thanks for being with us on the European Market Open. Emmanuel Cao, Head of European Equity Strategy at Barclays. Coming up on this programme, we'll be speaking to Pierre Wunsch, the Governor of the National Bank of Belgium. That conversation coming up. Of course, he is also a member of the ECB's Governing Council. Our colleague Maria Tadeo just getting set up for that exclusive conversation. That's coming up next. She'll be talking to him about inflation, the energy crunch, the economic recovery and the ECB's stimulus plans. Perhaps a little bit of reference to plans relative to the Fed. That would be interesting. We will be back with that conversation next. This is Bloomberg.
Is inflation really transitory, or is there a risk that, because we believe it's not transitory, it actually becomes sticky?
I think central banks are really worried about inflation now. Much of what we see probably is transitory, but nevertheless, it's a lot easier to see upside risks to inflation than downside risks. None of us know where inflation will go over the next year or so, but upside risks are coming, I think, from three sources. One, as we gradually learn to live with COVID-19, the bottleneck effects are pushing up some prices. Secondly, energy prices, we've seen, even yesterday, they moved all over the place for gas prices. We don't know where they'll go, but it's much easier to see upside risks than downside risks. And third, and I think one which is very different from the past 20, 30 years, is that the political risks are also much stronger. There's real pressure now to boost public spending, but not to raise taxes to finance it.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
From New York City,
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening. This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
Welcome back to the European Market Open. 11 minutes into our European trading day, European equities moving to the upside. Let's turn to the European inflation conversation. Inflation in the euro area is 3.4% year on year, far beyond the ECB's goal of 2%. Some policymakers have recently started to warn that price pressures could become more persistent. It sets the scene for an intense discussion on the future of stimulus when the ECB meets at the end of the month. For more on this, our European correspondent Maria Tadeo joins us now from Brussels with a guest on the subject. Maria.
Yes, Anna, good morning. And we have a very special guest, Pierre Wunsch, who is the central banker, the head of the Belgian Central Bank. Let's just go straight into the interview because I have a lot of questions for you. Time is short of the essence. I remember the last time you spoke publicly, you did signal that you were concerned perhaps about some of the guidance that the ECB was giving out in terms of the rates and the interest rates trajectory going forward. The debate right now seems to be moving more about the shortage economy and inflation. I wonder, how concerned are you about the uptick that we're seeing in prices, and also how sticky do you think it is?
No, I mean, indeed, I had some, I was not fully comfortable with the forward guidance that we decided, but it was because essentially we were potentially talking about something that would take place 4 or 5 years down the road, and didn't feel comfortable having a proportionality assessment of what we could do then. But in the meantime, we had a number of inflation surprises. So the debate today is a bit more about whether inflation is going to be temporarily higher or whether it's going to turn into something which has a dynamics of its own. I think there are very good arguments to say that a lot of what we see today is temporary in nature. We have base effects, and of course we have supply constraints, but also because it's lasting a bit more, and we know that some of the supply constraint will take some time to abate, maybe a year or so, that it could turn to something that is a bit stronger in terms of second round effects, and there is uncertainty there. And actually, we could afford some second round effects because we want to go back to our target. We are not at our target in Europe, which means that our policy will have to remain supportive. And I think it's important to make the distinction between, exiting the PEP, which was an emergency program that was really related to this COVID crisis, and the fact that if we decide to exit the PEP, and I think, the economy is moving in the right direction, so we could at some point decide that we still have to, fall back on our, not traditional tools, but the tools that were there before, the APP, TLTROs, and others, because we are not at our objectives. So we need, in any case, to remain patient.
And you make it perfect for the follow-up question that I wanted to ask you. It was a good segue because you talked about the the pandemic program, perhaps coming to an end. The market assumes that will be what will happen in a few months, but there's now a real debate in terms of what comes next, whether you go back to the old toolbox or, in fact, you go back to your traditional tools that you have, but with added flexibility. Is the market right to assume that even if you were to go back to your traditional tools, that there will be an element of flexibility that you didn't have in the past?
Well, of course, traditional is a moving target, what you mean by traditional. But we had the APP before the pandemics because we're not at our objective. The pandemic program is a program related to the COVID crisis. We are going to exit at some point, but then we will still be doing QE. So it's important to understand that if we would exit the PEP, that's not exiting a very supportive monetary policy to get back to our 2% objective, because we are not, structurally, we are still not at our objective. Of course, today, if you read inflation numbers, they're probably above 2%, but that's the story about it being probably to a large extent temporary.
And on that, I think there's a nuance that's very important. Of course, you're saying this is still an economy that would need stimulus, but with the pandemic program, the difference there is that it allowed you some leeway that perhaps the more kind of recurring or traditional, so to speak, tools that you had in the past would allow you to. I'm thinking perhaps, the Greek bonds, for example. Is that something that you think merits a debate, that the new perhaps continuation after March would need an additional element of perhaps state-of-the-art kind of?
Look, my take on that is we've been quite flexible. We have a broad instrumentarium. We've confirmed in our strategy review that those tools, QE and others, are now part of our basic toolbox, that they should not be considered as very exceptional. And we've been using them for 7 years. So I think we've shown a lot of flexibility in the past. Whether we need here and there to change our instruments, we're going to have the discussion. But basically, I think we have a good track record. And, crisis or difficulties come in many ways, and I think it's always possible to foresee precisely what could take place. So we need to have some flexibility when we are faced with whatever shock or difficulty. And again, I think I really strongly believe the track record has been good in the last few years. We've shown flexibility, and we've been quite supportive of the economy. And I would say, essentially, my message is no regret. What we've done so far was proportional, and I think needed and required, and I hope we will still in the future, get it right. But basically, I think so far the last few years we've gotten it right, and this is a crisis that we have managed quite well. On the monetary and fiscal front in Europe, and it's not that there was explicit coordination, but there was a lot of support from both fiscal and monetary front, and it's going to last for a while because we are still not at the end of this story of inflation being too low, but also we are still in the process of a recovery.
And you mentioned the fiscal kind of package that we've seen from the Commission and the European Central Bank and the institutions here in Brussels working together quite well in this crisis. There's a big debate in terms of what's going to happen with the fiscal rules in Europe at a time where potentially you're also debating what to do with your QE program. How important is it that you do it in a way that's coordinated? And I know the institutions are independent, but this is happening at the same time.
Well, I don't think we should speak of coordination here. We've been supportive because it was a big crisis. And naturally, of course, monetary and fiscal were supporting the economy together. I guess, again, the name of the game going forward, if there is a recovery and inflation picks up, is going to be some form of exit on the fiscal front and maybe also at some point on the monetary front. And then we will start, of course, with PEP. Fiscal rules are very complex in Europe, but they are very complex because of maybe a difficult history with added layers. There are strong arguments to simplify, but then people don't always agree about how to simplify. So we'll see where it gets us. But at the end of the day, monetary policy, of course, has to take into account what takes place in the fiscal front, but it's largely two separate discussions.
And just as a final question, of course, we know the decisions will have to be made at the ECB. The market is not really expecting anything to happen in this meeting, but in December, perhaps that could be a big one. Of course, you sit there in the governing council. How would you say the mood is inside? There's been perhaps later reports that there's more tension building.
No, I don't think. I mean, we had unanimity on the last decision, so that's far from tension. I think there is now a lot of uncertainty about where inflation is going. It seems that we are at some kind of inflection point. And basically, it's good. I mean, again, we are below our objective. So we could afford some second round effect, but not too much. So I guess one of my colleagues put it this way. We need to be patient, but we need as well to be vigilant.
Well, Governor, thank you so much for your time. Always good to see you in
Thank you
Belgium.
So much.
By the way, your Spanish, congratulations, is very good.
Thank you.
So
Thank you for that.
I could go Belgium many languages.
Muchísimas
Well, thank you so much, Anna. Well, that was, of course, Pierre Wood, who is the central bank governor of the National Bank of Belgium, speaking to Bloomberg this morning.
Thank you very much, and thanks for doing it in English. My Spanish, not so good. Thanks to Maria Tadeo with Pierre Wunsch from the National Bank of Belgium there. Coming up on this programme here in the UK, banks start rolling out the new £100 spending limit for contactless payments from today. We've got that story next. This is Bloomberg.
Essa população é uma população importante, é uma população que frequenta a escola também, né? Então é importante que eles também estejam protegidos para o coronavírus, evitando assim a transmissão.
Eu estava esperando muito por essa vacina. Desde o ano passado eu estava torcendo logo para poder minha vida logo voltar ao normal, que eu quero logo voltar para a escola, eu quero voltar a sair com meus amigos, eu quero sair, eu quero voltar à minha vida normal. Foi toda administrada.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Saying it has accelerated innovation in the country and it's planning to appeal the FTC's decision. What's your take on this and how do you plan for further scrutinies?
We are going to see what they make and what changes they are actually bring to this market.
Welcome back to the European market open. 22 minutes into a trading session that is broadly positive for European equity markets. Moving to the upside, the DAX underperforming a little. Now, here in the UK, banks will start rolling out a new £100 spending limit for contactless payments from today. Contactless payments surged during the pandemic, with some shops refusing to take cash anymore to help prevent the spread of COVID-19. For more, we're joined by Bloomberg's Charlie Wells. Charlie, very good morning to you. Yeah, the pandemic did seem to sort of supercharge this process away from cash towards electronic payments and contactless ones where you don't even have to put in a PIN number. So what does this UK card increase then tell us about the future of the payments industry?
Yeah, so it's a really hot space. So we know that debit cards here in the UK are used more than cash. Cash is really waning, which is concerning to some consumer advocates. But during the COVID pandemic, this has been a huge boon for consumers and retailers. But this is just one of many changes that are in the payment space, right? So we've got contactless payment surging, we've got cryptocurrencies, we've got buy now, pay later. Let's not forget that Brits spent £3 billion last year using buy now, pay later. So this is a contested space.
Okay, yes, there's plenty of people after this. So who is pushing for this change? Who is it who's saying, I don't want to spend, what is it at the moment? The limit before today was 40 or something.
Pounds, yes,
yeah,
exactly.
So who's saying, this is not enough for contactless, I need it to be more?
Well, banks love this. So let's just remember that credit cards date back to the 1960s. So anything that banks can do to make those pieces of plastic more relevant to the modern consumer, they love. Consumers like this. So we know that there are 2 contactless cards for every 1 single person here in the UK. So that's a quite large adoption of this technology. Interestingly, retailers are a bit lukewarm on this. So their association put out a statement recently that actually said to proceed with contactless with caution. And I think the concern there is fraud.
Yes, absolutely. I mean, what is the limits? Is this limited to just cards, or is this also about other devices? Because you can use your phone to pay, you can use Apple Pay, Google Pay, and all those tools.
Funny that you mentioned Apple Pay, because that is a really big concern here for banks. And so, you know, banks are huge legacy institutions. They know that they need to adapt. They've seen Apple come into some industries and really disrupt things. So early on, banks partnered with Apple Pay, but this increase to £100 helps banks take some control away from Apple, because it makes their cards more attractive than, say, Apple Pay technologies, which require banks to pay Apple.
Okay, so this all sounds good if you like the idea of going into shops and getting out quickly and tapping your card and leaving. What about if you lose your card and someone goes off spending your money? I mean, how protected are we in this situation?
Yeah, so this is something that I'm concerned about. And we know that debit cards, credit cards, and store cards are one of the most commonly stolen items here in the UK. It actually right now is on parity with wallets or purses, which says something about where we are in technology. There are limits on this, but of course, you know, this is one of the reasons why retailers are a bit concerned as well, because 2% of transactions actually require someone to enter something, even though it's contactless, enter, say, a PIN or touch a machine. And of that 2%, 16% of those transactions allow someone to walk out of the store without paying, so inadvertently taking something. So there are concerns on the personal level and on the business side here.
Okay, sure. And how does this change our behavior? How has this move towards technology really shifted our behavior then?
Yeah, so there's a really striking new study that actually came out this year that showed that when people were given the prompt to use a new type of payment technology, it actually lit up the reward area of their brain more so than with cash. And so we know that the less friction there is, the easier it is to pay, the more likely it is that someone could pay. But this study actually showed that it's not even just about friction, it's about the kind of excitement of using a new technology. And so that's a lot of fun, but also these new methods of payment that we're seeing could potentially get us to pay even more.
That is really interesting. I like the way it's exciting.
Right.
We're not fearful of it. That's an interesting one. Thank you very much, Charlie. Thanks for bringing us the story. Bloomberg's Charlie Wells on the future of payments. Coming up on the programme, as consumer habits shift back from online to in-store in some cases, how are internet retailers adapting? We'll discuss with the CEO of the flower delivery company Bloom and Wild. That is next. This is Bloomberg.
They don't know what to say. Again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
What we have built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
We've been through a lot, us as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their missions.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open. 30 minutes into your European trading day, here are your top stories. The bulls roar back, global stocks rally amid earnings optimism and a fall in US jobless claims. The S&P 500 posts its best day since March. Goldman Sachs rounds out the week for big bank earnings after the surge in pandemic deal-making, and trading continued for rival US lenders. And European car sales slumped to their lowest level since 1995 as the chip crunch takes its toll. A very good morning, everybody. Welcome back to the European Market Open. Half an hour into our trading day, and let's take a look at where we are on these European equity markets. We've got Stocks Europe 600 moving to the upside, up by around 1/4% this morning. The Xetra DAX a little bit of a laggard, up by a 1/10% or so. The CAC 40 up by 0.6%. The FTSE 100 up by 0.3%. So that's the picture across these European equity markets. Let's have a look at things from a sector perspective, because we don't necessarily see a reaction in the auto space that we might have expected this morning. Yes, we've got weakness on the Xetra DAX, but actually the auto sector not necessarily all to the downside. We've got actually autos and auto parts up by 0.9%. Banks are the biggest gaining sector. Retail also up there, along with travel and leisure and energy. We see energy moving to the upside as oil prices continue their gradual push higher that we've seen through this week, feeling more comfortable above $80 a barrel, it seems, on the oil price. But we do have autos moving to the upside. And in fact, I was just looking at the sector as a whole, and all of the participants in the autos and auto parts sector moving higher, which might surprise some given the negative headlines we've been covering around autos. Maybe that is all priced in. Maybe we already knew that chip shortages were such a big headache for that sector. Personal consumer goods and grocery stores, that is the worst performing sector this morning, down by 1/4%. Healthcare down by 0.2%. Now, the great rotation in consumer habits is underway. Shoppers are increasingly heading back to the high streets after lockdown forced them to buy online. In the UK, the share of internet retail sales dropped in August to the lowest since before the pandemic. Flower delivery company Bloom & Wild has seen business blossom. Very nice. More than trebling sales in a year. But how will the company adjust to this new phase as we feel increasingly comfortable getting out of our houses, away from screens? Joining us now is Aaron Gelbart, who is the Bloom & Wild CEO. Aaron, really nice to speak to you. Really interesting to talk to you about your business. I wondered, though, whether you're seeing any drop-off in business, any reluctance to still shop online when we can get out, we can go to the local florist, we can buy flowers that way. How is that consumer behavior evolving?
Good morning. We're very fortunate, actually, and are seeing our customers stick with us. A large number of people tried out online flowers and Bloom & Wild in particular for the first time during COVID, had a great experience, and are now continuing to order for themselves and for other recipients too.
Okay, so you're not seeing too much of a hit from that kind of phenomenon. You're a business that's also spent lockdown doing a lot of M&A, expanding across Europe. Tell us about your European ambitions. How big do you want to be?
That's right. We're already the leader in the 25 billion euro flower and plant market, having acquired Bloemon in the Netherlands and Bergamot in France this year. But we still also have under 1% share of that market. So there's a huge amount of opportunity to continue to grow in markets like Germany and France, where we're already present, and then further countries across Europe over time.
So you're doing a lot of this European expansion on the other side of Brexit, Aaron. I don't know if you have a sense for how business would have been if we had still been members of that European Union. Does it matter at all to the business you're in? Has this thrown up trade barriers, or is this something that you can just sort of sail through?
There have been some trade barriers, in particular, bringing flowers into and out of the UK has more complexity than it had before. We did have some time to prepare for it, so have navigated it okay, albeit with some barriers.
Yeah, speaking of things that have been difficult, what about a shortage of drivers? Is that something that your business is suffering from?
We've been fortunate on the shortage of driver front. In the UK, we work primarily with Royal Mail and DPD as our delivery partners, and we found both of them to be reliable and resilient in face of the challenges. So we've continued to be able to offer a reliable service to our customers, which is obviously super important in a perishable product category like ours.
We're heading towards COP26, and some people might feel like they're asking themselves questions about all kinds of consumer behaviour, and maybe asking questions about flowers and the number of miles they travel before they get to your table. What are you saying in that kind of context, Aaron? What's the way that you sort of justify that this kind of business is still worth consumers' time?
Of course. So our business is climate neutral, which is really important to us. All three of our brands, so the Bloom and Wild brand and also the Bergamot and Bloemon brands. And we have a shared commitment to doing business sustainably in terms of sourcing our flowers and carbon footprint, also in terms of not sending waste to landfill, using fully recyclable materials. And I think our consumers really appreciate that we are on the front foot in terms of our sustainability commitments, and we'll continue to push that further ahead moving forward.
Will you need to fundraise again? Do you plan to fundraise again, Aaron? What's the story there?
Our business is well funded. We raised in the region of £100 million over the last year, led by General Catalyst and Index Ventures, and so as a result of that, we're well funded for our current plans, but always ambitious, and we'll always consider the right moves in due course.
Aaron, thank you very much. Thanks for joining us. Aaron Gelbard, Bloom and Wild CEO. Lovely flowers in the back of the shop, as you would expect. Thanks very much to Aaron for joining us. Let's get a Bloomberg First Word News update. For that, here's Laura Wright. Good morning, Laura.
Good morning, Anna. French Finance Minister Bruno Le Maire is calling on the US to drop trade tariffs against European countries after the global deal on corporate taxes. The US is unhappy at French levies on tech firms, which Le Maire says will be abolished when the new global agreement comes in. Speaking to Bloomberg, he also says the Allies have a different approach to China.
The United States want to oppose China. Europe wants to engage China. So there is a difference of view. We need to discuss about that because this is clearly a strategic question.
Bloomberg has learned China is loosening restrictions on some mortgages at some of its biggest banks, adding to signs of growing concern by authorities about contagion from the Evergrande debt crisis. Financial regulators told some banks late last month to accelerate approval of mortgages. Lenders were also permitted to apply to sell securities backed by residential mortgages. President Biden says the number of unvaccinated Americans remains too high, and he's calling on more businesses to impose mandates. Speaking from the White House, Biden also said U.S. health officials will decide soon on Pfizer and BioNTech's COVID-19 vaccine for children aged 5 to 11.
We're going to continue protecting the vaccinated. This week, the Food and Drug Administration and the FDA is reviewing data on Moderna and Johnson & Johnson boosters. We expect a final decision from the FDA and the Centers for Disease Control and Prevention, the CDC, in the next couple of weeks.
A partially destroyed Banksy painting has sold in London for a record £16 million. Previously known as Girl with Bloom, the piece was partially shredded as an artist prank after it came to auction back in 2018. Renamed Love is in the Bin, it became a cultural phenomenon. After closing the bidding, the auctioneer joked he was relieved that the artwork was still there. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Very nice. Laura Wright here in London. Coming up on the programme, back to the bank earnings story. The CEO of Morgan Stanley is preparing for rate hikes and says the markets are ready for them. Don't miss our interview with James Gorman. That's next. This is Bloomberg.
Of the Greek economic debacle. What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh, my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question. Wonderful. Who of you has a driver's license?
You don't need that.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the European Market Open, 42 minutes into Friday's equity trading session, and European equity markets are in the green, not by all that much though over in Germany on the Xetra DAX, but elsewhere we have some heftier gains. Certainly the French market, the London market doing a little bit better. Let's talk about where we are on some of these individual stock names then. We've got one of the automakers in our stocks to watch this morning. Let's start with Renault. This a focus not necessarily because of the stock itself, but for the sector, up by 3.3%. It seems that autos managing to do pretty well despite the fact fact that we had that the auto story out this morning is that we saw a plunge in registrations in Europe, 25% weaker. That is the weakest September since 1995, the weakest September in more than 25 years. But that doesn't seem to be the story that's caught the market's imagination, or perhaps it was priced in as we see risk assets move to the upside today in a global rally in stocks. Hugo Boss, let's focus on that one as well. The clothing, the attire maker, the suit maker, or is that too narrow? Hugo Boss moving to the upside because of the sales update that they have delivered to the markets. They raised their profit forecast and said revenue is exceeding pre-pandemic levels, a sign that formal wear maybe is back in fashion. People dressing up just that little bit to get out of the house once again, to leave the Zoom calls. Let's talk about what's happening over at Temenos. This is a software business, of course, and that's not moving to the downside. Shares falling. Analysts over at Barda saying that the third quarter update was a pretty mixed bag. Well, Temenos share price reaction doesn't look all that mixed right now, is down by 13.3%. Back to the banking sector, but sticking with earnings, Morgan Stanley CEO James Gorman is preparing for rate hikes and says that markets are ready for them. He pointed to wage increases, supply chain bottlenecks, and surging commodity prices driving inflation higher. Gorman spoke on Bloomberg Markets.
We're continuing to see share gain and extremely good performance across the whole investment banking sales and trading platform. I don't expect the investment banking pipeline to slow down at this point. It remains very robust. And then as, eventually the Fed starts tapering, move to rate increases, you're going to see more volatility in the fixed income space, which we'll participate in. So there's a lot of stuff going on right now.
Well, let's speak to those challenges for a second, James. You had said during our earnings call a little bit earlier to watch out for volatility. Many of your peers have been very worried about interest rates. What are you most worried about as we start to close up this year still?
Well, I think I just said you've got to be mindful. I mean, we're seeing sharper movements in the market by the day. Some of the sort of earlier bubbles around SPACs have clearly gone off the boil a little bit. There's more geopolitical tension between the US, China, talk of Taiwan, etc. So I think you've just got to be, our job is to be mindful and to, on the one hand, have your foot on the accelerator, but the other, constantly be looking for where the big potholes are. And that's basically what I mean by being cautious. But honestly, in the next several months, I think the market has digested that the Fed will have to move, not just on tapering, but on rate increases. And by the way, we're 10 rate increases away from what would be considered normal. We could do 10 quarter-point rate increases. So bringing it up a little bit over the next year that's not a crisis and not unexpected.
So you said not a crisis. So do you think that a lot of people who are worried about the next correction in the market, are those fears misplaced?
Oh, the people are always worried. I mean, markets go up and go down, one wise person once said. And, when you've got basically free money, record fiscal stimulus, global synchronized growth, of course the market's going to do well. I mean, whenever are they not going to do well? If this environment doesn't make it happen, none will. But that doesn't mean that it's going to go in a straight line forever. I've been doing this a long time. You have corrections. You have moments of excess. You have reassessments. The investor's psyche changes. We'll go through one of those periods, but I'm not expecting some major crisis. And, nothing like the shocks that we've been through in the last 30 years that were really material.
Do you see this wage pressure on the industry lasting for a while? And what is that going to do in terms of the ability to control expenses at the end of the day?
Yeah, Shonali, I really don't think it's going to be that important to what we do. I mean, this industry understands when markets are good, they're getting paid better. When they're not, they're not. If you don't perform, it goes down. So I think that there are some natural sort of hedges within these kinds of businesses that the traditional companies don't have. So honestly, my focus is on making sure we pay our people well for great jobs done, and they'll get paid great for doing that. That's our focus. But it's not an anxiety around wage inflation for this kind of company. Very different industries, obviously. Affected dramatically, but what I see is real wage inflation around the world.
You seem pretty confident about the trajectory we're on. You see clearly some bumps in the road, but you don't see inflation getting out of control. You see this as being something that we can manage our way through.
Well, I mean, that's my assumption, is that the Fed will manage through. I mean, they'll have to bring rates up. My prediction, Guy, has been for a long time, I've been much more hawkish. I would have brought rates up, certainly by the first quarter of next year, I'd start moving. They have a lot of capacity to move, and I think you've got to prick this bubble a little bit. Money's a bit too free and available right now. So, yeah, we're seeing, you know, and I'm not a buyer of this story that it's all transitory, the inflation story. It's not transitory. I mean, wage inflation is real, and the supply chain interruptions, and you were talking about some of the natural gas and other things, have clearly been real. Some of that is temporary, but not all of it. So I think we're in a period where inflation is going to tick up. I think it's going to force the Fed's hand to move a little more aggressively than they're probably predicting now. And you saw that in the dot points that came out at the last FOMC meeting. I think, if I'm right, there were 5 dots for a rate increase in 2022. That moved to 9 dots at the next meeting. So we're seeing it through the Fed's own numbers.
He would have been more hawkish. Morgan Stanley's chairman and CEO, James Gorman, on the results of the business, inflation, and what the Fed, in his view, should be doing. Let's get a Bloomberg Business Flash with all the latest corporate stories we're following. Here's Laura.
Thanks, Anna. In a watershed moment for cryptocurrencies, Bloomberg has learned US regulators are poised to allow the first Bitcoin futures ETF to begin trading next week. Unlike ETF applications that the SEC previously rejected, the proposals by ProShares and Invesco are based on futures contracts. The ETFs were filed under mutual fund rules that SEC boss Gary Gensler has said provide significant investor protections. Microsoft is shutting LinkedIn China, citing a significantly more challenging operating environment and greater compliance requirements. The service has around 52 million users. It makes LinkedIn the latest major US social network to pull out of the mainland. Virgin Galactic is pushing the start of commercial flights further into next year after rescheduling a test flight, disappointing investors with an unexpected delay into its space tourism plans. An upgrade to the company's spaceplane is taking longer than anticipated, delaying commercial takeoffs into the final 3 months of 2022. That's the Bloomberg Business Flash. Anna.
Thank you very much, Laura Wright, here in London with your Business Flash. Coming up on this programme, we've been hearing bank CEOs weigh in on the inflation debate. We'll continue that conversation with our Markets Live team next. This is Bloomberg.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European market open. 8:52 here in London. European equity markets moving to the upside, only just in the case of the German market, but we are moving higher. Just a bit of breaking news for you across the Bloomberg. Brent oil hits $85 a barrel for the first time since October 2018, as we continue to see oil prices then recovering from those pandemic lows, and lows they really were, negative in some cases, of course. Let's get to the Markets Live team. Noor Al-Ali is with us from the M Live team and can reflect on what we're seeing on oil here. And I was reading the words of one of our colleagues, well, your colleague on the Market Live blog, Noor, Sung-Woo Park, who was saying that oil is really enjoying life above $80 a barrel. That in the context of WTI, perhaps. But Brent is now above 85. And we had some data on storage at Cushing that seems to indicate that perhaps oil prices will continue to go higher from here.
Yeah, absolutely. I mean, you've got the tightening in the market here. You've got key oil indicators all pointing towards that the bulls are finally in charge for oil. And, you know, what's not to like about this? When you're an OPEC plus producer, you're making good money, you're an exporter, and also this is doing really well when it comes to these exporter countries. You're looking at Canadian dollars, the loonie, the Norwegian krone, the Russian ruble. They've all been performing very well in the past 6 weeks. All of this just to point out that crude is actually going to enjoy a really good boost coming into that year end, especially with the energy crunch and all these supplies really falling.
Yeah. It's going to be a really interesting earnings season, talking to the executives at oil companies, you know, ahead of COP26. Maybe some of them might have been, you know, reflecting on their transition, but now they're going to be talking about higher oil prices as well. Let's think about inflation. We've heard a lot of chatter over the last 24 hours, Noor, about how inflation is not transitory. It is a bit more sticky. James Gorman at Morgan Stanley, Mohamed El-Erian, Larry Fink, they were all saying that this isn't going to be transitory. What have you learned about that inflation narrative this week?
Yeah, absolutely. I mean, we've just talked about oil prices. You've seen that spike. And once you've got that sticky type of spike from energy prices, it's going to be much harder for central bankers to tame inflation because, you know, these CPI prints, they've heavily been weighed down by energy costs here. So that's something to keep in mind. You know, I think the use of the term transitory has been misplaced. And I think now it's time for us to shelve that and put it aside. I think now is the time for us to understand the fundamentals that have been weighing on inflation. And right now it seems that it proves to be a little bit more sticky, but it could perhaps just be a shock that economies are facing for the time being.
What about Bitcoin? Bitcoin being shocked to the upside because of some potential news we might get out of the SEC and further signs of acceptance into sort of mainstream finance, I suppose.
I was waiting for you to ask me about Bitcoin. It's the day, it's the moment for Bitcoin. Look, if I'm going to summarize what I think about Bitcoin or what's happening right now, I'll tell you that cryptocurrencies are assets that are generally sentiment driven, right? So when we talk about them, the more we prop them up, the more we discuss, you know, you've got the SEC ETFs approval, you've got some, you know, some movement in Canada and Europe as well. All of that to say that when you talk about positively about Bitcoin, that's going to move. But also the key thing, the key takeaway here from is that previous rallies that the Bitcoin have been mainly driven by retail investors. Now, as we step on whether or not the SEC is going to approve this futures ETF, this might be a completely different rally driven by Wall Street. And that's something that's extremely interesting because it's going to test the fundamentals of the market that's currently under pressure. And I'm talking about miners here in China and whether or not they can stand the true test of real money coming in now.
Okay, Noor, thanks so much for joining us. Noor Al-Ali from our Markets Live team. Remember, you can find commentary about the markets. MLI Vigo is the function to use on your Bloomberg if you wish to do that. That is it for the European Market Open. Surveillance Early Edition is up next. They'll be taking you through all of these markets. We have European equity markets moving to the upside, maybe not as strongly as they were. We're up by 0.2% on the Stock 600. Just looking at the sector breakdown, we're actually fairly evenly split on gainers and losers. Banks doing well on the back of strong results out of US banks, perhaps. Energy also doing well. No surprise there when we see the oil price moving to the upside so aggressively. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
There's always a balance between the free speech and being responsible and taking down content that we think could lead to some kind of real-world harm.
Fed will have to move, not just on tapering, but on rate increases. That's not a crisis and not unexpected.
Right now, that inflation is clearly not temporary.
I would put 50% probability on the dissipation story and 50% probability on the persistent story.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Goldman Sachs rounds up the week for big U.S. bank earnings after the surge in pandemic deal-making and trading continued for rival lenders. A watershed moment for the crypto industry, while Bloomberg learns that the SEC is poised to allow the first U.S. Bitcoin futures ETF to begin trading. And European car sales are the weakest since 1995 in September as the chip crunch takes its toll. Later on in the program, we also speak to car company turnaround expert Stefano Aversa. Now, first of all, though, let's check in on the markets, and we're having a couple of encouraging news, actually giving a lift to some of these markets. Now, we look at Brent. It's always a good idea when talking about the energy crisis, and after the week that we have had, to look at Brent. It did hit briefly $85 for the first time since 2008, currently at 84.87. Now, we are expecting some measures coming from the European Union to try and help companies and give them a little bit of relief. Some of these measures have been laid out. We'll see what happens with it. Bitcoin, it was one of our top headlines with the SEC possible doing some Bitcoin ETFs. 59,278 is where we're at. And overall, there does seem to be a boost in the markets because of bank earnings in the U.S. that were pretty solid, and also a little bit of a boost because we're seeing China relax some of their rules as regards to mortgages. So actually loosening some of the restriction on home loans. Again, one of the other big stories, of course, Brexit between, the whole of the EU and the UK. I don't know whether they're talking tough at the moment or actually whether something could seriously happen. There are a number of scenarios where there's been tough talk, certainly from the Commission out of Brussels, saying if the EU messes up or if the UK messes up with Northern Ireland, there will be retaliation. So this, for the moment, is not really being played on the markets, but at some point it could, so keep a very close eye on it. So it's been another bumper quarter for U.S. banks. Morgan Stanley's investment team is, of course, scored their best 3 months ever, boosted by a pretty torrid pace of M&A. Citigroup equity traders also surpassed analyst estimates for a fifth straight quarter, and Bank of America beat as fees climbed at the company's deal-making unit. Now today, it's the turn of Goldman Sachs. Executive at all of those lenders seem to agree on one thing for the month ahead: inflation is here to stay.
I'm not a buyer of this story that it's all transitory, the inflation story. The supply chain interruptions, natural gas and other things have clearly been real. Some of that is temporary, but not all of it. So I think we're in a period where inflation is going to tick up. I think it's going to force the Fed's hand to move a little more aggressively than they're probably predicting now.
Right now, that inflation is clearly not temporary, and as people worry about, it's more permanent, and a way to conflate that is start to get to work on it.
Inflation in general, obviously, is running at a much higher pace than I think we thought it would be, just a few months ago, and certainly going to be there for a little bit longer. We are seeing a little bit of pressure in wages, but not across the board. Really only in certain pockets of the company.
Well, joining us now for more on all of this is Michael Moore, our managing editor for finance in EMEA, and then I'm looking forward to having a conversation with Steen Jacobsen on some of the financials as well. But Mike, first of all, what are the overarching themes for U.S. bank earnings so far?
I mean, really, it's been a continuation of the
trading and investment banking gains that we saw throughout the pandemic have continued. The 4 banks that we've seen so far have put up $33 billion in trading and investment banking revenue. If you look at a couple of years ago at this quarter, that was more like $25 billion. So that's a couple billion each of additional fees and trading gains. And it's really been across the board. You know, for a couple quarters there, it was all about fixed income. Now it seems like the deal environment is lifting things. So that the investment banks are the kind of engines here. But I think there has been some disappointment on the other side of the house in terms of loan demand, both in consumer and commercial loans, and whether that will pick up, you know, despite the gains we've seen in the economy.
So, Mike, very, very quickly, I mean, investors seem to, I guess, make a big difference between some of the banks. So what are we expecting for the next quarter? Is it going to be, I mean, financial is where investors want to be as a protection for inflation, because, of course, it changes the yield curve. Does that bode well for banks?
Yeah, I think if you start to see the Fed move and raise interest rates, that could be a boon to some of those lending businesses we were talking about. You know, they've been at near zero rates for so long that, you know, margins have been compressed. There's only so low you can take deposit prices. So I think that will be a lift to some of these lending businesses. And yeah, the banks have seen a big rally over the last year and a half. So I think investors are, you know, setting a higher bar for some of these firms in terms of what they can do going forward.
Mike, thanks so much. Michael Moore, there, our managing editor for finance in EMEA. Now we're joined by Steen Jacobsen, Chief Investment Officer at Saxo Bank. And Steen, I'm delighted also to have you in the studio. I love your notes. I always get feedback, actually, that you look at the markets in a slightly different way and often are right about them. So first of all, how should we look at some of the earnings seasons that we've had so far as it pertains to inflation? So it's all about inflation. What happens to inflation now?
I think the important part is all the CEO is now saying it's not transitory, which is the narrative that the Federal Reserve has been feeding us forever. And I think Federal Reserve is really way behind the curve. So I think the banks are preparing themselves for an increase in the yield curve, as you talked about, which will improve earning down the line. And down the line, of course, I think they know that the market will correct itself.
Yeah, but Steen, how can policymakers get it so wrong? So I don't know whether, you know, I actually don't know who to believe, because it's two cases. You either look at, you know, markets and chief executives, or you look at central banks. And there's a feeling in central banks that actually we're having all these shortages because people are overbuying as they prepare for shortages. So it's like a feedback loop, like the waterfall effect. And that in 6-7 months, you know, we're going to have suppressed prices because everything comes roaring back.
I think that's an interesting conversation, but that is the political narrative created either by politicians or financial markets. So how I see the world is that we've had a financial world that's been totally separated from the real economy. So our number thing, which I told you 50 times, is that the physical world has now become too small for the political aspirations and policy that we enact, which is fiscal transfers and liquidity provision. Interesting. So if it was supposed to be that it's just you and me buying too much toilet paper, then of course it will be sort of mitigating itself over time. But there's nothing that liquidity or fiscal boost can do to increase the base load in the UK in terms of energy. And every single energy and inflation spike that's been in history has always been driven by energy crisis. We have an energy crisis in October, not in January, not in February, not in March. So God forbid that we actually get a very cold winter this year, then we'll have a real issue at hand, because we cannot increase the base load. We have underinvested into it. And you see now that mining companies like Fortescue makes more money than a payment company like Visa.
Yeah.
And still people are not buying. Do you know what the P is of Fortescue is? 5. So unless you are, you know, if you don't have to play by the narrative, which is ESG, a very loosely defined ESG, there is massive opportunity in the real economy, logistics, mining, and everything else. And I think the example of Fortescue, of course, is probably the most evident and clear one.
So, Steen, what does it mean for a policy mistake by central banks would be what? Not hiking rates? I mean, at the moment, they're talking about tapering. Should we now price in like proper rate hikes? And what does that do to companies and the economy and markets?
So we need to price in catch-up effect. So I think you and I have grown up in a market that works what we call in continuous price faction. So 2022, 2023, prices. Now we see price jumps. You see silicon jumping by 300% in the space of a month. And I think interest rate would do the same ultimately, because instead of having this slow grinding move up and down, it's 153, next day you come, it's 156. One day we're going to come in and it's 175. Why? Because of the policy mistake. And what happened with Powell and Fed in September was no mentioning of the word transitory in the statement, and ever since the markets have been repriced. In the UK, we have priced 60 basis points over the last 2 weeks. So the policymakers are behind, and when they are behind, they need to get ahead. For why do they need to get ahead? Because in their mind, they need to have interest rate high enough to be able to cut them again. So they will drive interest rates simply from the policy reaction for them, which is we need to get rates back to a level where we can actually cut them again.
The UK, how much separate do you keep the UK because of some of the driving forces that are very unique to the UK because of Brexit and also lack of drivers?
I think it's a great laboratory for what goes on in the rest of the world. It's a small open economy. You have been sort of embedded very, very big lorry drivers and the structure and everything else. But think about like the best performing windmills in the UK right now is the windmill offshore in Scotland. Why are they the best performing? Because they're not working. Actually, the government pays them not to do electricity provision at a time where you're short baseload. We have a baseload effect. Electricity, getting these turbines to run on a constant basis cannot be ruled what we do, but the policy response will be more green, more fiscal, and then we're just going to make the world even smaller than it is physically relatively to financial markets.
Have you started buying Christmas presents because of the supply chain issues?
You know I'm cheap, so I don't really spend a lot of money on Christmas.
We'll give a call to Father Christmas. Steen Jacobsen, Chief Investment Officer at Saxo Bank, stays with us. We'll talk a lot more about China and cryptocurrency next. Coming up, Bitcoin futures will be allowed to trade from as soon as next week. We'll speak to Eddie van der Walt and Steen Jacobsen of Saxo Bank on this next. If you have any questions, you can send them through on IB plus TV Go. This is Bloomberg. When you look at technology, how should we be looking at big banks and technology?
Technology is our friend. So it's helping us transform the bank fundamentally. And in fact, we're speaking, I think, as we speak, to our shareholders around what we've done and how we've transformed the bank. We also see technology and technology companies as partners. So some
not
of our
rivals.
You know, we know that there are big parts of what have been our business historically that will be absorbed into convenience platforms. And by convenience platforms, whether that's Amazon or Facebook or Alibaba or Tencent or something like that, those are platforms that are just very convenient for people to conduct their day-to-day financial affairs. And it'd be very difficult for a bank to compete with that. Now, in some cases, I'd say, let's say in Africa, we are setting up a competing platform to the convenience platforms. And we're working with technology companies and mobile telephony companies and others to create a platform of our own. But for the most part, we're going to be playing on somebody else's platform.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacroix here in London. Now let's turn to a Bloomberg scoop, and we've learned that the SEC is poised to allow the first U.S. Bitcoin future ETF to begin trading. Now, it would be a watershed moment for the cryptocurrency industry. Now, let's bring in Bloomberg MLive's Eddie van der Walt, our great crypto watcher, and we'll be back with Eddie, and we'll be back with Steen Jacobsen in just a second as well. Eddie, look, first of all, this is a big scoop because actually it just means that it could go much more mainstream than it already is.
Oh, absolutely, and we have seen a price reaction to it, right? I think this is a really big story. Bitcoin has been waiting for this. Of course, U.S. investors could get access to ETFs via other venues, like in Canada or in Europe. But this is a really important development because for a lot of people, they want to trade on their home exchanges, and now they can do so if it's traded in the US. Now, there's one thing that I will keep in mind, though. This is a futures. This is backed by a futures contract, not by actual Bitcoin. And that actually, in the long term, is not extremely bullish for Bitcoin demand, I don't think.
Eddie, we also had a survey saying that there was a large chunk, actually, out of 7.1 trillion, I think it was an MSCI survey, saying that there was like a lot of exposure to cryptocurrencies. I mean, does that make it much more present, the regulation, if it's going more mainstream, without actually the, I guess, old street finance realizing?
Yeah, I love that story because it just told you know the mainstream investor that whether or not you're a crypto bull, crypto is creeping into your portfolio, right? Via diversified funds. Just because these companies are becoming so big. And listen, there is a lot of excitement about cryptocurrencies, and because they are so bullish, we will see the exchanges and all of the infrastructure companies that deal with cryptocurrencies. They will continue to do, to grow, and therefore, all of us will get greater exposure to it.
Thank you so much, our Bloomberg MLive's Eddie van der Walt. Now we're back with Steen Jacobsen. Steen, are you like fully invested in crypto?
Fully invested. I have 7% fixed in cryptocurrency in my 100-year portfolio, which is Saxo Bank's sort of educational / recommendation. So yes, we are fully. And I think what happened over the course of the last 24 hours is just vindicating what some people in the industry, among them Cathie Woods, has been saying for a while. You have to remember that the evolution of asset classes as a portfolio manager. In the 1960s and 70s, portfolio managers in the UK and the US didn't have real estate. So they went to real estate to get diversification and access to a different attribution in terms of return. In the 80s, it was hedge fund. In the 90s, it was private equity and venture capital. So it's not unnatural that we have this evolution. I think what we're happening right now with this, that happened overnight, but also generally with the acceptance of we're moving towards more KYC compliance and the way I trade the ETF, of course, is through exchange based because then I have full disclosure relative to both my employer but also to the tax authorities. So we are moving into the fact that it's becoming a real asset class, basically.
But is this, I mean, is it Bitcoin or actually is there something? So I keep on hearing that, Bitcoin is the thing right now, but in 1 or 2 years, because of regulation, there could be another greener product out there. So maybe we don't even need to look at Tether and things like that.
So there are 3 iterations. Blockchain, which was the first one, has scalability issue, environmental issue, and basically it's, but it works on the fact that it has a limited supply. You have standardized contracting, Ethereum and the likes, and then 3rd generation, Polkadot, Cardano, and another other thing. I think the ultimate winner, you have to remember the construction of crypto is really that it's the payment for doing transaction on a blockchain. So ultimately the winner, which is indirectly your question, will be the technology that is compliant to environment, which is compliant to scale, and which is probably also KYC in order to be accepted by the payment system.
But we don't know which one it is yet.
We don't know which one it is, and you need all these things to fulfill. And right now people are saying, Bitcoin can do whatever it needs because it's just a store of value. Standardized contract, okay, but as a commercial venture, I always make the analogy. It's like Bitcoin and cryptocurrency right now is like Nokia phone when we got the flip phone and we had text messaging. And you and I was massively excited, right? But it really only took off when Apple introduced the powerful iPad, the iPhone, right? Where you have multiple apps, we have multiple amount of people working on the apps, which is called nodes in the crypto world. But like a network like Ethereum has, I think, 25,000 people working on it right now in nodes. It needs bigger scale. It needs to be bigger, but it's definitely being adopted institutionally, now also in a legal framework, and it's becoming a real asset class, in my opinion.
Steve, we're out of time, and you talked about China and Brexit. So what do you want to do first? China, how do you play it?
China has changed the business model. They're just going from being, trying to be emulating what happens in Hong Kong and the US. They're moving to a Scandinavian model. The amount of economists in China now ask me for papers on welfare and the way we do things in Scandinavia. So Xi Jinping wants to take himself away from Deng Xiaoping, and he sort of opened up with China. Now they're the dual economy, harmony, and everything else. But right now, it looks like there's a fundamental value in China.
Right, but what does that mean actually for their relationship with the U.S. investors or Western investors in general?
I think the pivoting out of Afghanistan was a move to actually afford themselves to be competing with China. So I think that meeting is still it's supposed to happen and going on. But I think a lot of investors asking the question I heard earlier on the show this morning, also had someone in talking about it. But bottom up, all these companies is what the investors in Asia need. Don't forget, MSCI Asia is 40% of China. So where you want or not, if you're an Asian investor, you need to be investing in these companies. So I think people are picking up on the side. But I think overall, back to the whole thing, they also have an energy crisis, right? And they are slow in terms of adoption of vaccination. So I'm a little bit concerned for all of the markets in the sense that we have this rate sensitivity that comes out of the energy crisis. And don't forget, we are not even into the winter yet in terms of the impact on energy prices.
So could you actually see a big market correction in the next 2 to 3 months, coupled with, that could come from COVID, lockdown, monetary policy mistakes?
The next move comes from what I call the step ladder increase in inflation and rates. And every recession we ever seen has come from energy crisis. So you have the setting of energy crisis. Put very, very quickly, what we need in the world is the amount of cost of energy go to zero. Right now it's going to infinity. So that is going to hurt both the market, the interest rate, and inflation.
All right, Steen, thank you so much. We'll have to get you back because we didn't even talk about Brexit. We talked about the Bank of England and inflation, but not about Brexit.
No one wants to talk about
we
Brexit
will. No
anyway.
one wants. But are you playing it? Are you buying stuff in the UK? If it turns ugly?
Yeah, but I'm actually very negative on growth in the UK because of what Johnson did. So I'm very negative on sterling.
All right, Steen, thank you so much. Steen Jacobsen, their Chief Investment Officer at Saxo Bank, joining us this morning. Now, coming up later in the program, Belgium's central bank governor tells us policy will remain supportive for the near future, even as supply constraints add to uncertainty. We'll hear from our exclusive interview from Pierre Ridge. This is Bloomberg.
So the 1972 Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses because we have a captive audience. We have people home that really want something to do and need entertainment. So we do our best to try to give it to them.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned China is loosening restrictions on mortgages at some of its biggest banks, adding to signs of growing concern by authorities about contagion from the Evergrande debt crisis. Financial regulators told some banks late last month to accelerate approval of mortgages. Lenders were also permitted to apply to sell securities backed by residential mortgages. Now, a partially destroyed Banksy painting has sold in London for a record £16 million. Previously known as Girl with the Balloon, the piece was partially shredded as an artist's prank after it came to auction in 2018. Renamed Love is in the Bin, it's become a cultural phenomenon. After closing the bidding, the auctioneer joked he was relieved the artwork was still there. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, I'm disappointed you weren't the buyer of the Banksy. I have to say, it was pretty punchy. Even I had a double take in saying, wait, is it 2 million or 24 million? We'll talk a lot more about art shortly. Coming up, the EU sees its worst September for car sales since 1995. With me to discuss is company restructuring expert and Alex Partners London Managing Director Stefano Aversa. That's coming up shortly, and this is Bloomberg.
OECD nations need to end coal use by 2030, developing nations need to follow suit by 2040, and we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Goldman Sachs rounds out the week for big U.S. bank earnings after the surge in pandemic deal-making and trading continued for rival lenders. A watershed moment for the crypto industry while Bloomberg learns the SEC is poised to allow the first U.S. Bitcoin futures ETF to begin trading. And European car sales are the weakest since 1995 in September as the chip crunch takes its toll. Up next, we speak to the car company turnaround expert Stefano Aversa. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I keep on getting messages from traders saying we have made it to Friday. Indeed, we have made it to Friday, so happy Friday, everyone. I'm Francine Lacqua here in London. The market's definitely on the move for a number of reasons. First of all, they look in China and actually think what we've heard from China in terms of some of the loosening tactics, certainly for mortgages or home buying, is seen as a positive. The other thing we need to watch out for is Brent Crude. It was at $85 a barrel very briefly, but we hadn't seen that since 2018, now at 84.84. Again, this just goes back to some of the concern surrounding the energy crisis. We're also hearing from the Commission and European leaders trying to say, well, we need to fix the companies somehow or give them a little bit of relief. So we could see a bit more on energy price relief over the next couple of days, and then Bitcoin 59,068. Again, markets supported by some encouraging U.S. bank news. Now, car sales in Europe have just seen their worst September since 1995, with new car registrations diving by 25%. Now, the ongoing semiconductor shortage is causing production losses. The news isn't all bad for automobiles, with electric vehicle sales continuing to accelerate after a good 2020, fueled by government incentives and a change in attitudes. Well, we're joined by Stefano Aversa. He's Global Vice Chair and EMEA Chair at Alex Partners. Stefano, right here, has more than 30 years experience driving turnarounds for industrial companies, including car makers. So, Stefano, thank you so much for coming back to the studio here at Bloomberg. Look, Stefano, there's some, I mean, we talk about the chip crunch, and we talk about it almost on a daily basis, affecting the supply chain. I have to say, for me, when I read the headline that even Apple, deep pockets, wonderful supply chain is being hit, I thought, well, what hope is there for everyone else?
Yeah, it's actually a bigger problem that look at the beginning. There are a number of reasons why we are where we are. The main reason is that supply chain, particularly long supply chain like chips, let's take into account that it takes about 9 months from a chip to go from the start into a vehicle, do not like shocks. They like stability. And in the case of pandemic, there was a shutdown of plants, both automotive plants and chip plants, and it takes 9 months to restart. Plus, you had to refill the supply chain. And automotive represent only 8% of the total chip market, so they are not particularly important. And also, there are chips that are a bit special because they are subject to thermal shocks, to vibration, so they tend to be on traditional and smaller wafer, not to be too technical, but it's a 200 millimeters, while the much more efficient wafers now are 450 millimeters. So the capacity in the last several years have been on the large wafer.
Right.
So the combination of smaller capacity, shock in supply chain, and the fact that there have been a significant ups and downs created the problem we are in.
But Stefano, so how do you see the energy transition as well? So one of the other things that we try and figure out is that if you're a car company or if you're a consumer and you say, oh, I want to buy a car, but I don't exactly know how much I need to pay if it's not a complete electric one, do you just use your old car until it dies before you understand rules and regulation going forward? Are you expecting better technology? Like, it seems that there are a number of unknowns for car makers that it's almost difficult to pick out what the main reason for some of this, pressure is.
There is a lot of uncertainty at all levels, including at producers' level. So I think it's a personal choice. It depends really on a mission. I think if you are living in metropolitan areas, electric can be a solution, particularly if you have the possibility to charge it at home. If you need to travel several hundred miles per week, probably it's not the best solution today yet, for all the reasons that are well known, the infrastructure, the charging infrastructure, the range, but also, frankly, an electric car costs about between $8,000 and $12,000 more. So also there is, from a consumer standpoint, this is a pretty heavy hurdle. So if you look at the future, I think I suggest that people really evaluate their mission, how they're going to use them. I suggest that they actually wait for next year. There will be a lot of new cars coming. There will be much more choice. There will be about 100 new electric vehicles coming in the market. And with more choices also will come probably some also reduced prices.
But so, Stefano, is this what's happening now? So if a year ago we had spoken and I said, well, 2021 is going to be worse than 2020, probably no one would have believed us, right? So how do you look at today's numbers and what does it mean for the kind of pressure? Could we see car companies, downsizing quite significantly?
Okay, there are two different phases. The phases of the pandemic brought down by about 20 to 25% the volumes. That was 2020, particularly the second through the fourth quarter of 2020. Then there was a restart, and it was actually a pretty quick restart. China basically had a 2020 which was about the same level of the year before. US restarted relatively quickly. Europe was slower. And then in the middle of the restart, the chip crisis started to hit. At the beginning, we forecasted between 4 and 5 million. Now we just, as Alex Partners came out with a new forecast of 7.7 to 8 million cars, which means 210 billion of losses for the manufacturer. And it could be even more. Because you have a compounded effect of the shipping constraints.
Energy, I imagine?
Energy itself, yes, of course. You drive a bit less. But more than half of the problem we have today are not generated by the pandemic, but the really lack of components.
Yeah. Stefano, thank you so much. Hold that thought because we'll talk a lot more about some of the anxiousness maybe that we can see in other sectors as well. Stefano Versa, Global Vice Chair and EMEA Chair at Alex Partners, stays with us. Coming up, patience required. Well, Belgium's central bank governor tells us that a bit of inflation could be a good thing for Europe, but we'll have to wait to see how the ECB will react. Well, our interview is next. This is Bloomberg.
Natanggap ko po ang inyong nominasyon sa akin bilang kandidato sa pagkapangulo ng Republika ng Pilipinas. I am a fighter and I will always be a fighter inside and outside the ring.
From
New York City.
We're here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
The United States wants to oppose China. Europe wants to engage China. So there is a difference of view. We need to discuss about that because this is clearly a strategic question.
The French Finance Minister Bruno Le Maire speaking to Bloomberg about Europe and its allies' approach to China. He's also calling on the U.S. to drop trade tariffs against European countries after the global deal on corporate taxes. Now, America is unhappy at French levies, of course, on tech firms, which Le Maire says will be abolished when the new global agreement comes in. Well, turning to from taxation to inflation, CPI in the euro area is also 3.4% year on year, far beyond the ECB's goal of 2%. Some policymakers have recently started to warn that price pressures could become more persistent. Well, the Belgian central bank governor, Pierre Wunsch, told Bloomberg earlier this morning that patience will be necessary before the ECB knows how to act.
So the debate today is a bit more about whether inflation is going to be temporarily higher or whether it's going to turn into something which has a dynamics of its own. I think there are very good arguments to say that a lot of what we see today is temporary in nature. We have base effects and of course we have supply constraints, but also because it's lasting a bit more and we know that some of the supply constraint will take some time to abate, maybe a year or so, that it could turn to something that is a bit stronger in terms of second round effects, and there is uncertainty there. And actually, we could afford some second round effects because we want to go back to our target. We are not at our target in Europe, which means that our policy will have to remain supportive. And I think it's important to make the distinction between, exiting the PEP, which was an emergency program that was really related to this COVID crisis, and the fact that if we decide to exit the PEP, and I think the economy is moving in the right direction, so we could at some point decide that we still have to fall back on our not traditional tools, but the tools that were there before, the APP, TLTROs, and others, because we are not at our objectives. So we need, in any case, to remain patient.
Well, that was our interview with the Belgian central bank governor, Pierre Wunsch, from this morning. Now, as the ECB keeps the taps open, what effect is that having on companies? Well, still with us is Stefano Versa, a global vice chair and EMEA chair at Alex Partners. And Stefano, we talked, first of all, thank you so much for staying on, but we were talking a little bit about this inflation dynamics and what this means for monetary policy. Is there a worry? And we've heard from Mario Draghi before he became prime minister. We heard from, the G20, the G30 group, actually, the worry about zombie companies. That once you get rid of, this monetary policy, we're going to be left with a ton of companies that just can't survive. Is that true?
It's still true, even if for the moment there is this blanket that has been put on the economy. Most companies received guaranteed loans from the state or agencies, and I think that would be still okay for several months to go.
Yeah.
Having said that, during 2022 and certainly in 2023, some of these loans need to be repaid, and I think we'll see some of these so-called zombie companies to be taken care of, so there will be a significant wave of restructuring consolidation.
Stefano, I just need to bring everyone aware of some news on Alitalia, which is just breaking as we speak. So the new state-owned airline, of course, ITA, we know a couple of days ago bought 28 Airbus jets, and we thought this was on a path to success. Now we understand that this Alitalia successor called ITA does not see a standalone future, and they have been approached by top competitors. I don't know whether we are going to see, I don't know how that translates into your world. Are we going to see more M&A for some of these companies that maybe don't need or should not be surviving unless they're like crown jewels of a country?
Yes, I mean, I think ITA or Alitalia is a case in point. There are no chances that a company of the size of Alitalia, without a very strong partner, or even better, being part of a larger group, can survive. The competition in Europe is fierce, and nobody can work only with regional planes with the size of Alitalia. So I think that was declared also by the new management. They are looking for an alliance, and the sooner the better.
Yeah, which is exactly what's going on right now. I think we have an interview with the chairman saying that, look, they've been approached and actually they don't see it as a standalone future. Is this symptomatic of other industries? Is this just for the airline industry also because of the pandemic? Or do you think we'll in general see more M&A and more consolidation amongst other sectors?
There would be consolidation, but probably done in a slightly different way. The world moved away from the globalization, the way we knew it in the year 2000. It would be much more regionalization. But in industries that have very high investments like pharma, automotive, aerospace, you need to have a global size to compete. Other industries like consumer goods or telecom, etc., can actually survive and thrive at regional level, but we will see a lot of consolidation at the regional level.
We were talking a little bit before about zombie companies. I mean, could we actually see a bloodbath in certain parts in Europe, but also the UK, when things are starting picking up? I don't know whether you see like this blanket of safety because of the pandemic that being taken out, and how many companies you're actually expecting to be in real trouble afterwards.
I think the solution is going to be mainly political, and I don't think that the blanket will be or could be taken out abruptly. So I expect that to be done, also because the political pressure. There will be always a next election next month, next quarter. So I think they will find solution to mitigate the impact. But we are working on a number of situations of reconversion of entire plants, or entire, in some cases, industries that through, for example, the energy transition, entire industries sectors are disappearing and need to be reconverted. And you have to think ahead, 3, 4, 10 years even. And the governments are starting to become smart in attracting and putting pressure on companies to help retrain the workforce, to bring new innovation, new products, but also, frankly, to attract new investment from all over the world. The reality is that that process will take some time. Not everybody will be easy to reconvert, and it's going to be a transition which will take the next 10 years. So fascinating times, but also for
busy
some
times.
difficult times.
Yeah, difficult times and busy times for you. What does it mean for the UK? So again, it's very difficult actually to read the situation, given also the acrimony that we've seen over the last couple of days between the UK and the EU. What does it mean for UK companies here?
The UK has a bit of a double whammy because of the Brexit, in addition. For the services, we learn how to do it virtual. I think UK will continue to thrive. I think London is not UK, will continue to thrive. But the industrial footprint of UK has started to suffer already for some years, and is going to be suffering going forward. Again, except for some industry like food, retail. When we talk about more technology, or we talk about automotive, we talk about aerospace, there will be certainly a negative impact. For a very practical reason, the UK logistically is not the best place to supply Europe, but also the cost. We also have to see how the currency will deal. It has some recovery, but UK has the possibility to use the currency as a competitive weapon.
Stefano, thank you so much for coming on today. Stefano Aversa, their Global Vice Chair and EMEA Chair at Alex Partners. Now, coming up, with just 2 weeks to go until COP26, our countries sticking to their pledges on climate aid from Paris 6 years ago. We tally up the numbers next. This is Bloomberg.
Morning, traders. Are you ready to trade Canadian dollar? I'm going to place an order to sell short Canadian dollar. The price I'm looking to sell, 123.468. Okay, so all of you guys who using our strategy, please place your order to sell short at 123.468. Okay, you know the strategy, you know how it works. So this is the price I'm looking to sell. Even I will go down. Please change your order to 123.465. Okay. I'll speak to you later.
China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, settled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
that I... What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Whether it's heat waves in Canada, storms in Texas, or flash floods in Indonesia, no country is immune from extreme weather events fueled by climate change. But not everyone is equally to blame, and not everyone can afford the massive costs of cleaning up disasters like this, or just as importantly, shifting their economies away from these sorts of things and embracing more of these. Take Africa, for instance. As a whole, the continent is only responsible for around 3% of global greenhouse gases, yet it's among the most vulnerable to the knock-on effects of climate change. Take the cyclones in Mozambique or droughts in Ethiopia. Those types of extreme incidents can impact food production and increase the risk of malaria. Some argue that wealthy nations industrialized over the last 2 centuries precisely because they were able to burn fossil fuels like coal. Now the goal is to keep these fuel sources in the ground in an effort to stop temperatures from rising even more. But what if you need to tap those fossil fuels to cheaply industrialize your developing country? While Joe Biden...
Okay, guys, position opened. As you can see on Canadian dollar, you got the strategy, you know how it works, and where to place stop and profit. For other people who just practicing, stay with me, and we will close this trade in profit. Okay, guys, well done. you enter trade, especially for newbies, for new people who just started trading, and you will close this trade with me, and we will see how much we're going to make. Stay safe, guys.
Governments worldwide shifted their focus to emergency response packages to cope with the shock of the outbreak. Another challenging element is that most of the money raised so far has gone to green technologies like wind turbines and solar panels meant to mitigate climate change. But fewer funds have gone to resilience measures like flood barriers needed to help countries adapt to extreme weather. UN Secretary General Antonio Guterres has said adaptation and mitigation money should be split 50-50. Developing countries have noticed the failure of rich countries to deliver on their pledge, and the inequality of the coronavirus vaccine rollout has heightened tensions. Without the promised funding, they say they are unable to announce tougher carbon-cutting goals, which are desperately needed to keep global warming below 1.5 degrees Celsius. Even if the $100 billion goal is met, the reality is that trillions, not just billions, will be needed to pay for the green transition.
Bloomberg's Jess Schenkelman there with a look at the key issues going into COP26 summit in Glasgow in just a couple of weeks from now. Now, you can watch more from Bloomberg Green this weekend on TV and online. This week's episode focuses on the causes and solutions to the global energy crisis. We'll also speak exclusively to the chief executive of Ecotricity about the UK utility landscape after 14 suppliers have already gone bust. So let's now take a look at some of the other key events to watch out for today. At 1:30 p.m. London time, Goldman Sachs reports earnings. We'll see if they've kept up with rivals that have seen a surge in deal-making and trading revenue. Later this afternoon, Angela Merkel will meet with the Belgian Prime Minister in Brussels as coalition talks rumble on in Berlin. And throughout the day, Brexit talks continue between the UK and the EU over the Northern Ireland Protocol. Well, the EU's chief Brexit negotiator has voiced optimism that the two sides will arrive at a solution in the next 2 weeks. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. Kaylee Lyons will be in New York. We'll have a full roundup of the market stories. We'll also talk about energy and, of course, Bitcoin. A big Bloomberg scoop on what the SEC will do in terms of Bitcoin ETF. This is Bloomberg.
When I had a look, it looked like she was blind. The vet that she's registered with were only doing telephone appointments, which was a bit pointless because she really needed to be seen by someone. And I couldn't get one anyway for like another week. I was just quite worried about, you know, the complications of leaving it for so long.
We've seen millions more animals becoming pets in the past year due to the people having increased time at home. What we're also finding is due to Brexit that we're having decreased numbers of European vets working over here. So unfortunately, we're unable to meet that current demand for pet services. Also, COVID's got the inevitable impact with people having to self-isolate.
it is very limited what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh, my God. Thank you to the gentleman out on Twitter that captured this moment.
Wait, question. Wonderful. Who of you has a driver's license?
You don't need that.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This inflation round is not transitory. We should take it seriously, and central banks should move quickly.
I think the market has digested that the Fed will have to move, not just on tapering, but on rate increases.
We don't think that the Fed will move to preemptively. We think that the Fed will be more cautious.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Friday, October 15th. Our top stories today. Equities on the march. Stocks and U.S. futures are higher today. Investors are encouraged by strong corporate profits and China's move to loosen restrictions on home loans. Goldman Sachs in the spotlight. While the firm's report will cap a busy 3 days for major bank earnings, investment banking fees are likely to soar. And breakthrough for Bitcoin. The SEC is set to allow the first Bitcoin futures ETF to begin trading. That's a very nice Bloomberg scoop. So, Kelly, if you look at the markets, they're actually pretty confident. I don't know whether they have a Friday feeling, but certainly they're looking at strong U.S. corporate earnings, especially the banks, and they're powering ahead.
I think we all have that Friday feeling today, Francine. It's been a really, really long week, and it is indeed almost over, including the last of the big banks reports coming from Goldman Sachs in just a few hours' time. Now, let's quickly recap what happened in the Asian session, because broadly it was a positive one. You had most stock benchmarks in the green, a lot of currencies and bonds getting a bid as well. Hong Kong and China were both up on the day, eased by the fact that China is going to be easing curbs on mortgages for the rest of the year, really trying to stem the Evergrande crisis. That actually helped out the Hang Seng Property Index, which was down as much as 1.3% at one point in the session, but actually managed to end the day in positive territory by about 0.5%. The big outperformance in Asian equities, though, came from Japan, with the Nikkei up 1.8%, and that basically is due to the weaker yen. The yen, once again, the biggest underperformer in both Asia and G10. It is weaker against the dollar by 0.5%, and at 114.25 on dollar yen, that is the weakest level of the yen against the dollar, going all the way back to 2018. Finally, had to point out coal futures as well, higher for a fifth day in a row, a fifth day of record highs for thermal coal in China. Thank you very much to the power crunch, as well as mining, coal mines being flooded in China. Coal futures at another record high today, up about 5%. Now, here in the U.S., we are coming off the best day for the S&P 500 since all the way back in March, and it does look like the gains will be continuing today, with futures up about 0.3% ahead of those Goldman Sachs reports. By and large, the bank reports have been quite strong. In the bond market, you are seeing some selling. The 10-year yield is up around 3 basis points. We're sitting right around 154 on that rate. Crude oil is heading for its 8th consecutive weekly gain. WTI this morning up about 0.7%. It was trading above $82 a barrel earlier. We are just off of that level now. And then I have to point to Bitcoin, as Francine alluded to, a Bloomberg scoop overnight that the SEC is set to allow the first futures Bitcoin ETF to begin trading. As a result, Bitcoin up about 2.5%, trading right around $59,000, Matt.
Kaylee, I also want to point out, MSCI came out with a report that Bitcoin is now tied to $7.1 trillion in stocks. You could see that as a positive story because more and more large corporations are embracing the technology, or you could see it as a concern because regulators, maybe even beyond Gary Gensler, will start to pay more attention to crypto. Take a look at markets, though. None of that's holding us back at all. In fact, obviously, Bitcoin is very positively correlated to equities, and we're rallying here in Europe pretty much across the board. You can see the biggest gains in Ireland and Italy, but we're up in the UK, we're up in Spain, France, and Germany as well. We also have yields rising here, as Kaylee mentioned. In the U.S., you see treasuries selling off and yields rising. Here in Germany, it's the same right now, up to negative 17 basis points on the bunds. I thought really interesting to look at Brent Crude. Now, this is the global benchmark. I know New Yorkers are going to look at WTI more instinctively, but everybody else in the world trades Brent. And for a while today, it was over $85 a barrel. Come back down a little bit, 84.68. But still up there. And then the pound is moving higher than any of the other major currencies here against the dollar. It's outperforming the euro. It's outperforming the Swissy right now. 137.21, the level on the British pound, as we worry more and more about Brexit, Francine.
Yeah, we do. I mean, the sound music from both the EU again and again and the UK has just gotten worse and worse. Acrimony is a pretty good word to describe that relationship right now. Now, a look at what else is ahead today. Big bank earnings continue, with Goldman Sachs reporting at 8:30 a.m. New York time. U.S. retail sales will also be closely watched at 8:30 a.m. New York time. Italy then putting in place some of the strictest anti-COVID measures in the world. All public and private sector workers will be required to show proof of vaccination from today, even if you go to work. Now, more on that Bloomberg scoop. We did learn that the SEC is set to allow the first U.S. Bitcoin futures exchange traded fund to begin trading. Now, this would be a watershed moment for the crypto industry. So let's get more on this with our Danny Berger. Danny, this is such a big deal because it makes it more mainstream, I guess.
It does. And you and I both have talked to a lot of Bitcoin bulls who really use this fact that they think an ETF will be approved as a thesis, as one of the pillars behind why they like Bitcoin, why it will go higher from here. And as Kaylee just pointed out, we are seeing it move higher, about 2.3%. Now, this isn't the first Bitcoin futures ETF, but it is the first in the U.S. should it go ahead and start trading next week. But really, what is key, what the Bitcoin bulls really want to see is not an ETF that's based on futures. They want to see it backed by the actual physical Bitcoin itself, although I realize saying physical Bitcoin a bit of an oxymoron. But this would allow Bitcoin to be more liquid. More people would start trading it because it's just available to a wider audience of investors because ETFs are so easy to buy and sell. So barring a last-minute turnaround, it looks like we will get the futures one, which just pretends well for an SEC approval of an actual Bitcoin-backed ETF.
I have to mention persistently transitory, which is an oxymoron that Mohamed El-Arian pointed out to John Farrow yesterday. I'm really in the market for those right now.
Good day for
I talked about the MSCI story, Danny. $7.1 trillion where the public companies have exposure to crypto. What kind of risk does that pose to an everyday investor?
Well, it kind of touches on the lightning rod, which I think you framed really well, Matt, that this could bring in more regulation into the fore because, yes, for an everyday investor, this might mean that they do have exposure to Bitcoin and they don't even realize it. Of course, they're the companies you would think of at Tesla where they put a lot of their balance sheet in Bitcoin, but you also have to think of the JP Morgans of the world that have started to dip their toes in offering crypto services. So if you're an investor, you own a wide benchmark, all of a sudden you do have some exposure to cryptocurrencies, and perhaps you don't like crypto, or perhaps you're worried about the ESG implications of mining or transparency. So this is something this MSCI study shows that you now have to be aware of.
It's like Jamie Dimon says, he thinks it's worthless, but if clients want it, JP Morgan has to deliver. Thank you so much to Bloomberg's Danny Berger. And let's stick with Wall Street because 5 big banks have reported so far and shown that business is booming. Bank of America CEO Brian Moynihan spoke exclusively with Bloomberg yesterday after his bank reported earnings that topped estimates.
We're back. In other words, the activity levels and what goes on day to day is bigger than it was before the pandemic.
And the busy week for U.S. bank earnings continues today with Goldman Sachs rounding us out this morning. Sonali Basak, Bloomberg Wall Street reporter, joins us now. Sonali, we are almost there. For Goldman today, is it once again going to be all about the deal makers and those advisory fees?
Yeah, I mean, we can easily expect Goldman to make almost as much or more than double than the amount it was making in merger advisory fees than it was in 2019. Wow. So we are back to more than normal in that respect. So for the traders as well, the expectations, remember, they were muted muted coming into earnings relative to what we saw at the other two banks. So if Goldman comes in at $2.2 billion worth of equity trading fees, they come in just below Morgan Stanley and JP Morgan. So the number to really beat is $2.6 billion at JP Morgan, and $2.8 billion is the big number at Morgan Stanley. So competitive market, but who's watching, right?
We are.
Obviously, investors are paying very close attention, Shonali. And yesterday, I thought it was interesting. The biggest losers on the S&P 500 in terms of point deductions for a while were financials, and then they turned around right around noon. What are investors looking for? Where's the bar?
I mean, the bar was very high coming into earnings, but remember, it's been such an incredible deal-making quarter, and some of that is continuing, Matt. So if you look at IPOs, undercounted here, the equity underwriting fees for Goldman are expected to be under $1 billion. That was more than $1 billion each for JP Morgan and Morgan Stanley. I mean, just a stunning number. And Goldman right now has the most share, according to our league tables, in equity underwriting. That is both lead left deals, it is equity overall, as well as IPOs, and as well as overall book running. So there's been a tremendous amount of activity despite the volatility. Volatility has been in a sweet spot, so much that you had James Gorman yesterday tell us that the Fed should pop the bubble a little bit here and raise as early next year.
Shonali, thank you so much. Shonali Bazak there on some of the U.S. Wall Street banks. Now, over to Washington, President Biden has signed a bill that raised the U.S. debt limit until December 3rd, setting up another bitter bipartisan battle, actually, that will likely unfold in a matter of weeks. Let's get straight to Anne-Marie Hordern, a Bloomberg Washington correspondent who joins us from D.C. So when are we going to see this acrimonious partisan battle resurface, Anne-Marie?
I think it's going to start happening starting next week when the House and the Senate, Francine, are back in session. They're off this week for recess. But this is just a Band-Aid, as you mentioned. This really just brings the U.S. to be able to, the Treasury to be able to continue borrowing, pay off debt by early December, potentially some leeway, but this is what that $480 billion is going to around December 3rd. That's also when the government, that stopgap funding measure to keep the government up and opening, federal employees paid, et cetera, that runs out as well. So it's going to be very busy weeks here in Washington, D.C., big partisan showdown. On top of that, the Democratic Party is still working out how are they going to move forward on their reconciliation, that big social spending package.
And this isn't the only headache for President Biden. We are still in the middle of a pandemic. And he said yesterday that U.S. health officials will decide soon on Pfizer and BioNTech's COVID-19 vaccine for kids aged 5 to 11. And of course, that was after the FDA approved the Moderna vaccine booster for older and high-risk individuals. Just take a listen to what Biden said at the White House yesterday.
We're going to continue protecting the vaccinated. This week, the Food and Drug Administration and the FDA is reviewing data on Moderna and Johnson & Johnson boosters. We expect a final decision from the FDA and the Centers for Disease Control and Prevention, the CDC, in the next couple of weeks.
So, Anne-Marie, how much more can the Biden administration do to push people to get their shots, the initial ones?
Yeah, the initial ones is a big deal, and this is just constant outreach, especially in rural communities and a lot of states that we are not seeing an uptick of those first initial shots. Yesterday was really about the boosters, though. The Moderna one, the FDA did not actually approve it yet, Kaylee. It is the advisory board that is recommending that, and we're still waiting. There's a number of steps. The FDA then would have to then take that on. But right now, we know for Moderna is that this advisory board took a similar step that they took with Pfizer and BioNTech. So those that are 65 years or older, those that are potentially immunocompromised or work in an area of high risk that are between 18 and 65 can also sign up for a booster shot of Moderna. That was what the advisory board had scheduled. We're still waiting to hear from the FDA. And the big one, of course, especially for parents that are concerned about children and going back to school as we really head into the fall now, is going to be what they do in terms of those ages 5 to 11 on taking up those initial shots.
All right, Bloomberg's Anne-Marie Hordern with an important clarification in Washington. Thank you so much. And now let's get back to the stocks moving in pre-market trading here in the U.S. And I have to begin with Virgin Galactic. Of course, Richard Branson's space exploration company absolutely plunging to the downside in pre-market trading, down more than 20%. And that is after the company delayed the start of his actual commercial flights to space even further out into next year. The fourth quarter of 2022 is what they're now looking at. So that's pretty disappointing to investors. Another stock moving to the downside is Duck Creek, the software company. It released earnings after the bell yesterday, and its 2022 revenue forecast came up well short of expectations. So as a result, that stock is down more than 14%. One mover to the upside, though, is Alcoa, of course, the aluminum maker. It beat by and large after the bell yesterday and also is going to pay out a dividend for the first time since 2016 next month, really benefiting from those higher aluminum prices. So that stock is up about 5% before the bell, Francine.
Yeah, a lot going on in some of these individual commodity or steel producers. Coming up, bankers sound the alarm on inflation. The chief executives of Bank of America and Morgan Stanley join other finance leaders in predicting that price pressures will stick around. So we'll talk about inflation and what a policy mistake would look like. Then oil gearing up for a bullish week ahead as the global energy crunch tightens the crude market. We'll get a check on commodities. And European car sales the weakest since 1995 in September as the chip crunch takes its toll. More on that story ahead. This is Bloomberg. Is inflation really transitory, or is there a risk that because we believe it's not transitory, it actually becomes sticky?
I think central banks are really worried about inflation now. Much of what we see probably is transitory, but nevertheless, it's a lot easier to see upside risks to inflation than downside risks. None of us know where inflation will go over the next year or so, but upside risks are coming, I think, from three sources. One, as we gradually learn to live with COVID-19, the bottleneck effects are pushing up some prices. Secondly, energy prices, we've seen, even yesterday, they moved all over the place for gas prices. We don't know where they'll go, but it's much easier to see upside risks than downside risks. And third, and I think one which is very different from the past 20, 30 years, is that the political risks are also much stronger. There's real pressure now to boost public spending, but not to raise taxes to finance it.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
There's always a balance between the free speech and being responsible and taking down content that we think could lead to some kind of real-world harm.
I'm not a buyer of this story that it's all transitory, the inflation story. The supply chain interruptions, natural gas and other things have clearly been real. Some of that is temporary, but not all of it. So I think we're in a period where inflation is going to tick up. I think it's going to force the Fed's hand to move a little more aggressively than they're probably predicting now.
Right now, that inflation is clearly not temporary, and as people worry about, it's more permanent, and a way to conflate that is start to get to work on it.
Inflation in general, obviously, is running at a much higher pace than I think we thought it would be, just a few months ago, and certainly going to be there for a little bit longer. We are seeing a little bit of pressure in wages, but not across the board. Really only in certain pockets of the company.
Well, top banking executives weighing there on the inflation risk. Joining us now to talk about the markets, inflation, and everything in between is Christine Aquino, who helps lead Bloomberg's market coverage. So, Christine, as always, thank you so much for coming on. Look, inflation. So you have the bankers saying inflation is not transitory, and yet you still have the central bankers saying, no, it is. And then we had that funny remark that Matt brought saying, well, maybe inflation is persistently transitory.
Yeah, I know. It's all about the narratives for inflation, isn't it, Francine? But no, I think you're absolutely right. There's this tension between what bankers are saying, what markets are expecting, right? And what everyday people are seeing in the prices of their grocery baskets, in wages, and what central banks are telling us. I mean, just before I came on here, I was reading a story about a London taxi company offering £5,000 as a welcome bonus for any drivers who are willing to join, right? So these are anecdotal evidence of inflation, whether you're a regular person or a bank CEO. But the question really is, when is that narrative going to convince central bankers, and when are they going to change their...
Okay, guys, let's play stop on profit. If a direction will change to a higher level, I think, no, broker will not allow us. Let's wait. Let's see what's going to happen next. We need at least 2 pips to play stop on profits for our position. So right now, this is too. We just can't place stop on our position. Okay, keep an eye on this trade. So we will see what's going to happen. It can happen any minute. We will see what's going to happen. So we will play stop, and we'll hold a stop. It means you will not lose any money at all on this position. So let's see what's going to happen during these few minutes. Okay, stay safe, guys. I'll speak to you later.
Between, the kinds of jobs that people are looking for, or anyone who's in the job market right now looking for it, and the openings that we have. I think some of the anecdotal evidence that we've seen of late, shows that a lot of these openings are very much kind of in the lower paid sectors of industries, particularly in the hospitality industry. And so, it's really kind of a question of how much will these workers want to be getting paid to go back into these very intensive but not very well-paid industries.
Christine, I want to bring it back to investment in portfolio construction, because I feel like there's been a renewed debate this week about whether or not the 60-40 portfolio is in fact dead. Where do you fall in that battle?
Look, I think there's always going to be demand for bonds. There are just big swaths of the investment community that will have to own bonds because of their mandates. We're talking about the big institutional funds, the life insurer funds. All of these groups of investors are constantly looking for good entry points into the bond market. And, earlier this week, I think we saw some evidence of that already, right? Where we saw a little bit of a bull flattening in the U.S. yield curve and other yield curves in major economies. We're also seeing some anecdotal evidence from Japan, for instance, big buyer treasuries there, and they were saying that a level of 1.75% for the 10-year treasury would probably be enough to entice them back into this market.
Christine, thank you so much. Bloomberg's Christine Aquino there with a take on the markets. Now, for more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
think at the low point of the Greek economic debacle, what were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms, and I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Well, this is Bloomberg Surveillance, early edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kelly Lyons in New York. Now let's get straight to the Bloomberg. First word news, and in China, there are more signs of concern about contagion from the debt crisis at property developer Evergrande. Well, Beijing is now loosening restrictions on home loans at some of its largest banks. They've been told to speed up approval of mortgages in the last quarter. In California, well, former President Bill Clinton has been hospitalized after a urological infection developed into sepsis. Doctors say he's responding well to treatment and will remain at the hospital for observation. Bill Clinton is 75. And it was the worst September for auto sales in Europe since 1995. New car registrations plunged to 25% to less than 973,000. Well, that's put the industry on track to the worse than last year's disastrous showing. Well, the automakers' lobbying group largely attributes the drop to the semiconductor shortage. And the pandemic unleashed a deal-making and trading windfall on Wall Street firms. Banking lenders point to signs that it's far from over, while earnings reports by 5 of the nation's largest lenders include revenue hauls from Investment Bank at Morgan Stanley and Bank of America. JP Morgan sees higher compensation costs to reward performance. Citigroup says it's been hiring deal makers. Now, coming up, more on U.S. banks with Walter Todd, Chief Investment Officer at Greenwood Capital. We'll look at the winners and losers, and of course, we'll talk inflation, what that means for the yield curve, and what that means for investment in banks. This is Bloomberg.
as Magnus TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life, and I think that is not the point, or that is not really the.
Okay, guys.
We are trying now to
stop. We place our stop for this position, so anything can happen. We will not end up in loss. 123.44.5. This is our stop position. It will give us 2 pips. In our case, it will give us £200 in profit. In your case, how much you decided to trade when you started trading, when you invested in Canadian dollar. Okay, guys, well done, good. We're already, about 30 minutes, okay, in the trade, and we're already in profit. Stay safe, guys.
This is Bloomberg Surveillance, early edition. I'm Francine Lachman, London. Matt Miller in Berlin. Kaylee Lyons in New York. And Matt, if you look at the markets, look, they're pretty happy about the U.S. earnings result, which means that they are not worrying at the moment about the future of energy and the energy crisis, and they're not too worried about inflation.
Yeah, I mean, you do see, obviously, energy prices climbing to a pretty high level. We saw Brent Crude here this morning eclipse $85 a barrel. That's the global benchmark. And we heard from the IEA yesterday that the problems with natural gas are bleeding into other energy forms, other fossil fuel prices, and that's driving up prices across the market. So I think it's really interesting that the equity indexes are continuing to rise in the face of that, because you would think that that kind of inflation would worry stock investors. I think a lot of them are going to tell you, though, there is no alternative still.
No alternative. Kelly, this is all playing out in the markets, but it does seem like we had a pretty nuanced week.
Yeah, we did. Of course, you had that higher than expected CPI, then lower than expected PPI. That kind of complicates the inflation conversation. And we are in a very busy week of bank earnings. And bank and earnings so far have been pretty good. 5 of them have reported. 1 is left, Goldman Sachs, in just a few hours' time. So we'll have to see how that one goes. But for the moment, big banks have been aiding risk sentiment. In Europe, stocks are higher by about 0.3%. Your biggest sector outperformer on the Stock 600 is, in fact, the banks. Here in the U.S., we're coming off of the best day for the S&P 500 since March. And futures are in positive territory once again this morning, up about 0.25% on S&P E-minis. While you're seeing buying in stocks, you are seeing selling in the bond market. The U.S. 10-year Treasury yield is up nearly 4 basis points. We're just under 155 on that yield at the moment. And then I have to point to Bitcoin as well because of the Bloomberg scoop overnight that the SEC is looking like it will clear the way to a Bitcoin futures ETF, something the crypto world has been waiting for a very long time. So that has Bitcoin up about 2.8%, trading above $59,000. No surprise then, if Bitcoin is moving higher, a lot of crypto-related equities are moving higher in pre-market trading as well. Bit Digital is up about 6%. You have Riot Blockchain and Marathon Digital higher by around 4.7% each. And of course, Coinbase is the crypto exchange, and it is moving higher by about 2% before the bell, Matt.
Yeah, you know, I thought the crypto news was really interesting, and not the only piece, the SEC, right? There's a lot more out there, but the price action in itself is what surprises me. $59,000 for a line of code. There's a lot of cash in this market looking for places to go. If you take a look at this chart, and for those of you listening on London DAB radio, I'll walk you through what you're seeing. M&A value, so deal value over the last, I guess this is a 10-year period, has just continued to climb and climb. Obviously, at the beginning of the pandemic, it dropped but we're now hovering around
Position close on Canadian dollar. We collected 200 pounds in profit. Well done, guys. Let's move on to another trading opportunity this Friday morning. You have the strategy, you know how it works. So keep going. Let me know your news, maybe what information, what you decided to trade today. You got my email address. I'll speak to you later, guys, when I will see what on this screen will appear, what other chance of trading opportunity will arise. I'll let you know and we'll trade again together. Stay safe, guys.
They think the activity is going to remain elevated. You talked about the liquidity in the market right now. I think, honestly, the bigger takeaway, the more important one for me, aside from the M&A activity, is the loan growth. We haven't seen loan growth from these companies in several years, honestly. And so we've, again, got a very consistent message from the CEOs that they're starting to see loan growth. They're starting to see credit card balances increase, spending's increasing. So very positive message across the board from those banks over the past couple of days. So that's encouraging for the outlook.
What about the old school business of banks taking in deposits and making loans? How is that doing in the face of, loan demand that isn't really that strong still?
Yeah. So if you look at that piece of the business, a couple of things. One, net interest margins look like they bottomed earlier this year. Again, you heard this from Brian Moynihan and Jamie Dimon on their calls that they're going to see a pickup in NII in the fourth quarter. So that's encouraging. And you are starting to see loan demand slowly increase, both from the consumer and the commercial side. So that's encouraging. And then the yield curve is steepened. It's not incredibly steep, but 120 basis points between 2s and 10s, that's going to help the margins at the bank. So some of that traditional banking business that's kind of been left for dead over the past couple of years is starting to reemerge. And I think that you're seeing the responses in the stock prices over the past few days.
Walter, good morning from London. How should we view the energy crisis? So is there a danger that actually the energy crisis, coupled with monetary policy, readjustment, means that a lot of companies will go under, will be left with zombie companies, and that hurts the banks?
Yeah, so Brian Moynihan on his call, or in an interview, said pretty emphatically he did not think inflation was transitory; that it was more permanent. And energy is one aspect of that. And I think that you're seeing the responses. We're not as concerned here in the U.S. As spend on energy and gasoline specifically is a much smaller component than it was, certainly 10 or 20 years ago. But in some of the emerging markets, it's more of a concern. It's a bigger piece of the pie of the spend over there. So that's something we're watching very closely. And clearly over in Europe, as you know, real spike in energy prices there. We hadn't even gotten to winter yet. So that is a risk out there and a concern that we're watching very closely. But at this point, it's not, the market's kind of looking through that and think we can get to the other side of it.
When you look at some of the things that we look at, Walter, which is, possible consolidation, I don't know whether you'll see some of the bigger players move on to more well-known fintech in the U.S. and whether that will change some of their valuations once fintech is fully valued by shareholders.
Yeah, it's interesting. Jamie Dimon spoke quite a bit about this on his call about the competition from non-banks. The new buzzword is, buy now, pay later, BNPL. We used to call that layaway when I was a kid. But anyway, it's you pay 30 times sales for that. And so you're definitely seeing that competition. I think there's a little frustration, from some of the leadership in the banks that the regulation on some of these non-banks is not as tough as it is on the traditional banks. But so they're using their capital. They have a lot of excess capital to get into this space. JP Morgan's made several acquisitions on that front. I think we'll continue to see that, but I don't see any of the large players that have gotten really too large, like Square and so forth, being acquired.
Walter, I was just taking a look at the thoughts you sent us before the show, and you make the good point that banks aren't really vulnerable to a lot of the supply chain issues and input costs moving higher that other companies are dealing with. If you put the banks aside, what sectors are you most worried about on the margin front in this earnings season?
Yeah, so for us, it's really, I think the kind of the middlemen, if you will, in the industrial space and some of the materials, specifically the chemicals. So we've seen a fair number of pre-announcements from both of those areas in the last call it month or so, and you saw the performance really suffer in the third quarter. Those were the two worst performing sectors in the market. So I think a lot of that's known now, but the question is how bad is the outlook? And so I think that's really going to dictate how those stocks in those areas perform going forward, is when we actually hear from the management teams and get beyond this quarter, which we know is going to take a hit from a margin standpoint, and what does the outlook look like? So those are probably the two areas I'd be most interested to hear from the management teams on.
And finally, Walter, there's been a lot of chatter this week about the 60-40 portfolio and whether or not it can still work. Do you think it can?
Yeah, so yes. The short answer is yes. We have a lot of clients that play in that space in 60, 40, 70, 30, whatever you want to call it, because we do think at the end of the day, if we have a significant correction in equity prices for whatever reason, 10, maybe even 20%, we're not calling for that, but it could happen. Bonds are going to provide a ballast in that scenario. Clearly, fixed income returns are challenged, but we do think having a mix of stocks and bonds makes sense for a lot of clients.
Walter, thank you so much. Walter Todd there, Chief Investment Officer at Greenwood Capital. Now, coming up, the SEC is set to allow the first U.S. Bitcoin futures exchange traded fund to begin trading. So we've got that scoop next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Breaking news just crossing the Bloomberg terminal. The PBOC saying Evergrande's risks to the financial system are controllable. China also asking banks to keep stable, orderly loans to real estate. The PBOC also urging developers and shareholders to fulfill their debt obligations. And Matt, of course, this is as we continue to deal with the ongoing Evergrande crisis and those missed dollar bond payments. And it's not just Evergrande anymore. It has a contagion effect. You had Fantasia defaulting on a payment as well. It's also spread to the likes of Cynic in China. So clearly China is trying to get a handle on this, and the PBOC attempting to reassure investors that these risks are indeed controllable and that Evergrande isn't going to lead to any kind of disaster in the Chinese financial system.
Good to hear that reassurance. We'll continue to keep on top. I mean, obviously they're going to say it's not going to lead to disaster. It would be more interesting if a regulator came out and said, this is going to lead to an absolute disaster that we can't control.
Fair enough.
but terribly
That's front-running
unlikely
chaos.
that would actually happen. The SEC is set to allow the first U.S. Bitcoin futures exchange-traded fund to begin trading. This would be a watershed moment for the cryptocurrency industry that we've been waiting for since the Winklevi. Let's bring in Bloomberg's MLive correspondent Eddie Vanderwall to talk to us about this. So it's been, I think, 8 or 9 years we've been waiting to get an ETF in the U.S. There already are a number of them in Canada that American investors, for the most part, have access to. But how important is this, Eddie?
Oh, I think it is very important, and we can see that in the price action. And you know what? There's been anticipation of this all year. It really, the SEC has been indicating that, look, maybe they don't like an outright Bitcoin-backed ETF, but they will be, you know, welcoming towards a futures-backed one, which in the near term is extremely bullish. And, you know, because there's a wider investment pool that will now have access to Bitcoin. We are bringing Bitcoin into the regulated space, and therefore more people will gain access to it. So I think, you know, in the very near term, it's very bullish. But I think the long-term picture for Bitcoin is slightly different on this ETF.
Why, Eddie? You know, why is that timeline actually different?
So look, I think what happens here is, you know, Bitcoin, the amount of Bitcoin outstanding is fixed, right? And no matter what you do, the algorithm creates as much Bitcoin as it will, and no matter what the demand is in the market. That's not true of futures contract, right? Futures contracts are potentially infinite. So therefore, if you're going to back it by a cash-settled futures, then it changes the demand-supply dynamics for Bitcoin significantly. And we've seen this in gold and other commodities as well. It displaces demand from people that would go out and register with an exchange that they will buy Bitcoin outright. And now suddenly they're going to buy something that's backed by a futures contract. And that's created volatility. If we look back at the commodities markets, if we look back at the oil market, right?
Yeah.
There's no reason why oil should have traded negative last year, or you know, other than the fact that it was backed by there was this futures backed ETF contract that went haywire. So that's a really interesting development.
Well, Eddie, let's talk more about volatility, because I think we've heard often that when you get more institutional buy-in, when crypto becomes more mainstream, a lot of that volatility will go away. And we haven't yet seen that happen. Does an ETF make a difference?
I think an ETF does make a difference. I think Bitcoin's volatility is subsiding over time, right? I think we saw a massive drawdown in 2017. The price crash in 2017 was something like 80%. Last year, when we had a mania, or earlier this year when we had a mania, when the prices collapsed, it was more like 40% or 50%. So I think, you know, Bitcoin remains extremely volatile and is still only acceptable for, you know, the type of investor who is willing to take on that volatility. But it is becoming less volatile than it has been. And I think that's an important development.
It certainly is. Eddie, thanks so much. Bloomberg's MLive, Eddie van der Walt. Now, coming up, we'll bring you Bloomberg's interview with the Bank of America Chief Executive, Brian Moynihan, after the firm posted better than expected earnings yesterday. That's coming up, and this is Bloomberg.
City.
We're here in London, in Sydney.
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines in New York with Francine Lacqua in London and Matt Miller in Berlin. Business is booming at Bank of America. The firm beat estimates in yesterday's earnings report, and its CEO, Brian Moynihan, spoke exclusively with Bloomberg's David Weston. Take a listen.
We're back. In other words, the activity levels and what goes on day to day is bigger than it was before the pandemic. We could talk about the economy and how that affects us, but the actual company got about half the people at work every day, and we're building that up as we go. And we've got, we're doing our job for our customers and our clients, our communities, and our shareholders, as you saw today, while we're doing that. But we're still partway to getting people back at work and normalizing. That's had a town hall today with hundreds of teammates in the audience, and it's feeling more normal, but we still got to keep pushing ahead.
But your business is fully back to the levels from pre-pandemic?
In terms of, production of credit cards this quarter, for example, we did 1 million new credit card customers with our discipline, and that's as much as we did in 19. And so if you think about the company, we were on an organic growth drive in 16, 17, 18, and then we hit the pandemic in 19, and then we hit the pandemic in early 20. What you've seen now is, you just imagine, just like the economy, that was on an upward trajectory. It dipped, and now it's right back on that trajectory. And so are our loans a little less than they were then? Sure, but year over year, the loans are basically flat. They've grown 2 quarters in a row and are building. And on the deposits, it's been 15% growth year over year, 12% growth, those types of numbers. So that's not the question. And then on investment banking fees and those things are at record levels, and core loans are starting to build, and that's all going to bode well for us.
Well, that was Bank of America Chief Executive Brian Moynihan speaking exclusively to Bloomberg's David Weston. Now we're joined by Tom Keene, co-anchor of Bloomberg Surveillance. He joins us. He's, of course, in Washington from the World Bank IMF meetings. And I don't know, Tom, first of all, congratulations on a number of really news-setting interviews, but I don't know how much the focus is really on energy prices there.
Well, it's not on energy prices, but the backdrop here is inflation. And, of course, part of that is commodities. It's a very different set of meetings. Francine, I'll be blunt. You're not missing much. It is a post-pandemic, within the pandemic meeting. Francine, I'm thrilled to do this with you. This is my chart of the year. I'm announcing it today. It is a Bloomberg Commodity Index, and it's taken logarithmic, which means it shows percentage change. And I didn't know this, Francine. I stumbled into this by accident off of a nice long-term moving average. The percentage change that we have used that we have seen, rather, in the last number of months is very rare. We've only seen it 4, 5, 6 times going back to the 1950s. The abruptness of this move is extraordinary.
It is. And what's behind it, Tom? Is this all about the, yesterday the IEA was saying the natural gas crisis that we're facing here is bleeding over into other fossil fuel markets?
I think that's true. I think Fadi Birol's done phenomenal work the last number of days. He has the best essay on Glasgow that I've seen so far. What I would point out, Matt, is that when you're looking at a blended commodity index, you're looking at the softs, the hards, oil, yes, oil, and there's a number of different stories here. The major story is we've had a commodity-free lunch for, say, 20 years.
I don't know if you call it a commodity or a currency, Tom, but as a Bitcoin futures ETF, your entry point?
Oh, God. Why, Matt, she's supposed to ask that question to you.
Matt's already found his entry point, Tom.
Yesterday, she didn't care about Bitcoin. Today, Kaylee wants to cover it. So,
there wasn't news yesterday.
$59,000 makes a difference.
You wise ass, here's what you need, Kaylee. You need to read Raphael Auer of the Bank of International Settlements. I ran into Benoit Carre yesterday doing wonderful crypto work at BIS, and he and I were talking about the truly foundational work of Dr. Auer at the Bank of International Settlements, and he's a little bit worried about some of the Bitcoin foundations.
Yeah, I bet he is. And then central banks maybe not talking the same language as some of the Reddit users. Tom, thank you. As always,
you guys are just dumping on me because it's Friday. This is terrible.
I know. It's Friday. You're in Washington, close to the White House. The sun is shining. We're all jealous, Tom. That's all it is.
The sun is shining. Weather's lovely.
There you go. Tom Keene there with the very latest from D.C. Now, this is a look at what else we're watching. And Kaylee, you're looking at U.S. data.
Retail sales data at 8:30 a.m. Eastern time. We are expecting a small decline month on month. Economists thinking they'll be down about 0.2% in the month of September. But a lot of that, once again, is probably due to autos, because when you back out autos, we're actually expecting a gain of about 0.5%. Obviously, Matt, a very important read on the consumer. Not that any read on the consumer is not important, but really how much are they going out into the economy and spending, as we have seen sentiment waning a little bit.
Yeah, I think it's also interesting to see what happens when you back out autos. We have horrible numbers a couple days ago in China. Today in Europe, a drop of 25% in sales, but it's all about the supply chain. It's not that people don't want the cars. They're going out and they're having to pay top dollar. That's why when you remove the autos component, you see a flatter picture there. I'm watching Goldman Sachs earnings coming out a little bit later today, capping off what I think has been a really fast week. I mean, we've been so busy with all of these bank earnings that I just feel like it's flown by. Goldman Sachs is going to cap it off. The bar was high, but I think has been lowered. We saw financials go from losses to gains yesterday, so it'll be interesting to see how investors react to Goldman Sachs today.
Yeah, but it also reminded us, Matt, that there's so much in the pipeline in terms of either IPOs or actually consolidation. Even if we have zombie companies, once monetary policy normalizes, that is always encouraging news for the banks because they get deals out of it and they have to step in and see exactly how to break it up. I don't know, anyone's guess. I spoke to a restructuring expert, actually, who said this could be, in the next 12 to 18 months, and watch out for specific countries like the UK. Now, we also heard from Evergrande that this is significant, not because they said that everything is under control, but it's significant because it's taken them a while to actually break their silence. Now, they say that risks to the financial system stemming from the struggle are controllable and unlikely to spread. And of course, this goes to the fact, Matt and Kaylee, that there is political will. If they come out and saying, look, the risks are controllable, to deal with it. And because China's China, you kind of take them at face value. If they say, look, we're controlling them, then actually they definitely have the levers to do so. So we'll have plenty more on that. Bloomberg surveillance. Coming up ahead, we'll hear from Kit Jukes, Société Générale Chief FX Strategist, and Margie Patel of Wells Fargo, amongst others. Also, from Monday, you'll be with Anna Edwards. I'll be doing the European Market Open. So, guys, I'll miss you, but I'm not far away. So we'll be able to talk markets, foreign policy, Europe, and Brexit at any given moment.
We'll miss you, Francine.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Google is saying it has accelerated innovation in the country, and it's planning to appeal the FTC's decision. What's your take on this, and how do you plan for further scrutinies?
We are going to see what they make and what changes they are actually bring to this market.
Pandemics change behavior, as we've already seen, and consumers might be worried.
Shortages both on the labor side and the supply side does remain a risk. But we think that this has been well telegraphed.
This inflation round is not transitory. We should take it seriously, and central banks should move quickly.
I've operated under the assumption that the Fed is pretty much sitting on the couch and watching this play out.
We should be opportunistically reflating. We should be saying, okay, inflation's now above 3%. Let's re-anchor it there.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Let's wrap up the trading week from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market up 14. We advance a third of 1%. Tom Keene, it is all about the twos. 2 days of gains, 2 weeks of gains, 2% away from an all-time high.
It's really, what a rebound, what a draw up it is. I did the math this morning, John, and the drawdown and back up. We've made back 64% of the gloom that we've seen, what, a week ago, 2 weeks ago? Think of what it was maybe a week ago this Friday. It's been an extraordinary week, stunning the gloom crew.
We bounced back, 8:30 Eastern, Tom. 2 events still to go, Goldman Sachs earnings and retail sales. Tom, just around the corner, 8:30, a couple of hours away.
I'll call them balanced, but to me, John, the real issue is the x-axis of the slowdown of this boom economy. And the tilt this week is maybe we don't get back down to those low single-digit numbers, 1-2% economic growth. Maybe that's pushed out a little longer.
Your equity market positive then, up a third of 1%. Lisa, you'll run us through the events into the weekend. Let's start right here. The PBOC says everything's going to be okay.
Yes, they've been trying to tell everybody that they have the situation under control and encourage banks to lend more on when it comes to housing debt. This time they come out and they say they're urging developers and shareholders to fulfill debt obligations. Please pay your debt. Please don't default. And then also saying that Evergrande's risks to financial system are controllable. This is what they want to sell, but the fact that they are getting a little bit more aggressive indicates they're still very concerned.
I am so done with this week already. Equity markets are positive. There's a lift in this equity market. We're heading towards a second week of gains, Tom. Your equity market is positive, up a third of 1%. TK, you've said it all week. The gloom crew taking one on the chin this week, up 15 on the S&P.
But let's remember, the week started Wednesday with bank earnings, and maybe that's part of the retreat of the gloom crew. The banks are in business, and they're minting money.
And we will wrap up bank earnings in about 2 hours and 30 minutes. Going into them, yields are higher. Yields were lower through the week on 10s, on 30s. Back end of the week, a lift, Lisa, up 3 or 4 basis points on 10s to 154.58.
Yeah, when we take a look at what's changed, I think the biggest change in the narrative is that companies can deal with the supply chain disruptions with the higher input costs because their revenues are just turbocharged and the consumer keeps spending. We will get a read on that at 8:30 a.m. September U.S. retail sales expected to come out softer in large part because of auto sales. When you strip those out, you start to see a bit of a gain, however, still softer in general. People are looking past this. They take a look at, for example, Bank of America seeing more credit card loans, and this is what has led Bank of America so far to be the winner. Yesterday, shares rising the most going back to January. 8:30 a.m. to cap off all of the bank earnings. Goldman Sachs coming out with theirs. A lot of people looking at advisory, a lot of people looking at investment banking revenue, but just to take a look at where we are over the past year. These are massive numbers. The idea that Morgan Stanley up nearly 100%, Bank of America up 87% in line with Goldman Sachs. JP Morgan, interestingly, already baked in with all of the dynamism that we're seeing. And then 10 a.m., this is the other really important moment of the day. U.S. University of Michigan sentiment survey is coming out. I want to see the inflation expectation. We have seen a downward trend in consumer sentiment, people saying this does not cohere with what we're seeing from businesses. But then you take a look at those 5 to 10-year inflation expectations among consumers, rising to the highest levels that we've seen going back to 2013 at about 3%. John, at what point does this matter for people looking at what consumers are baking into their expectations and their purchases?
Lisa, thank you. Let's talk about one thing that's underpinning that. Energy, Brent Crude, WTI, here's the move. Brent through 85 briefly, right now 84.77. WTI Crude, 82. Tom, we haven't been through 85, I don't think, since 2018 or so. There's been a real lift. We've been drawing down stockpiles, a story that's not unique to crude. We're seeing that in copper too, through 10K on the LME. There's a lift here again.
Yeah, there is absolutely, John. I turned to Commerzbank of Germany, who do a wonderful daily note, and Carsten Frist really drove into the microeconomics of this. He suggests, John, that when everything is said and done, it's implied that regular OPEC, not OPEC plus, but there'll be a call on further oil of OPEC plus because of the new demand realities.
Well, that's it, Tom, and I think you've nailed it. What's the ceiling for crude and for this rally? The point that this supply-side story kicks in the other way, that OPEC Plus has to react, point one. Point two, or it starts to hurt demand, Tom, and I don't know if we're there yet.
No, I think oil's very tough to pick, John, here, but the story that I'm getting across every style of every strategist is an always tight market is ever tighter here, and the dynamic now is not supply, which everybody likes to talk about. John, you and I are scheduled in Vienna the next meeting. No, it's about demand, the mystery there, and the answer seems to be more demand for hydrocarbons.
You keep planning this European tour, don't you? Lisa, that's one more location. Vienna, Glasgow, I know, I'm aware. Kit Jukes with us now,
list.
Chief FX Strategist at SocGen. Kit, let's ignore Tom for 5 minutes if we can.
Yeah, ignore me,
And the
please.
European tour that he's planning, and let's talk about this.
Okay.
How challenged is the Fed put, from your perspective? You've written about it this morning. How challenged is it?
Well, it's getting squeezed, isn't it? I mean, in sense of, and I think that's the biggest long-term picture that's coming out of here is, you know, markets think inflation is going to be somewhat higher for longer in the sense that once we get through this spike, we're not going back to the core PCE deflator at 1.5% and a little bit more. We're going back to something above 2%. That gives the Fed much less leeway to be nice to markets every time we get an equity sell-off, every time we get a bit of economic weakness, that they may find themselves just having to lean against this for longer and be less receptive. And so, you know, you've got to remember, we've had 20 years since Alan Greenspan decided deflation was scarier than inflation and put rates down at 1%, and have a look at what asset markets have done since then. That era, that particular era of being more afraid of deflation is almost certainly over.
Kit, amid all of this, we're seeing a little bit of dollar weakness after all of that dollar strength that we saw over the past 4 more weeks. Those seem a mile away, and now we have reflation back on. Why has the dollar not strengthened on the heels of what you're saying?
Well, it went up quite a long way, and it's a more complicated story for the dollar at the moment than it's been for a while. So it's done really well against the Japanese yen, which is the most sensitive currency out there to movements in short-term U.S. interest rate expectations. So that's been annihilated. It's had a good run against the euro, and we've just got stuck just above the lows. Looking at those European car registration numbers this morning, I think we'll just break lower in due course. But, you know, the Canadian dollar's got oil. The Australian dollars had been beaten up. The Chinese yuan is steady as a rock, and someone's keeping it there. And then the rest of the commodity-sensitive currencies having a good time. Emerging markets are having a hard time. Turkish lira is the only currency this week to be worse than the yen. So it's a mixed bag, but the dollar rising story is still intact, and the euro weakening story, which is the biggest part of it, is still intact at this point.
Kit, your micro work has always been great. We've been doing a lot of work this week on the American consumer. I'm ignorant about the European consumer now. Have they come back strong in goods?
They've come back to some degree in goods. They have some of the same issues on supply chains there as you have, as we have in the UK. The European weak point hasn't been as much consumer demand, and car registrations are a point. In fact, that's a chip shortage here, same as it is everywhere else. But you've got to remember, we're more sensitive to natural gas prices, which took off. Overall, we're more sensitive to oil because we have less of it. And in every way you can possibly imagine, we're more sensitive to our exports towards China and to the Chinese economy, which is clearly weakening. And those things are a real headwind for the European economy. But in terms of European consumers back at work, that they're spending money, they're filling bars. Here in London, London is much fuller than it was. But we didn't have, through the pandemic, the big one-off checks that Americans received, which filled their bank accounts and made and are making banks happy.
Kit, we're dancing around a key issue here. I want to get back to the point that you made this morning on the Fed put potentially being challenged. The previous cycle, the previous bull market, if you can call it that, was characterized by low volatility and a Fed that would step in every single time there was a sign of trouble. If you're saying that might be challenged this time around, what does the future look like? What does the market backdrop look like, the macro backdrop look like, if that's at the epicenter of it?
Well, it's vastly more uncertain. I mean, that's the first piece about it. But when we get the recovery sort of spreading out around the world, we are likely to find that central banks are stepping in earlier and are unable to, provide solace every time the global economy or markets take a little bit of a hit. So we get more volatility for a while until we get through some of these distortions. I mean, these are, Tom said it at the beginning, the energy market is seeing speed of move that's not been seen for years. That's not the only place we're going to see that in the next 2 or 3 markets. Sorting out labor supply demand mismatches, skills mismatches, sorting about global trade, sorting out some of the geopolitics at the end of it, sorting about differences of opinion about fiscal monetary policy integration. We've got all of this to do once we've sorted out this virus.
We've got a ton to resolve. Things have changed. Will things change on Monday for your beloved Gunners, Kit?
Well, they've improved. They're a lot better than they were the last time you and I spoke. So I'm half optimistic. We'll see. They are moving forwards.
I mean, John, I got to wait for the Tots Sunday. They play I don't even understand, John, what's going on at Newcastle. We'll talk about that later. But what I'm focused on is Chelsea. And Kit, I don't get it. I mean, Richmond tied Brentford, which was really exciting. And now Brentford's going to play Chelsea. Are they going to be so fired up after the Richmond-Brentford derby that
I think you
they're
might be
going to
confusing
surprise
fiction
Chelsea?
with non-fiction here, Tom. Just a little bit. Kit, run.
It's Bloomberg
surveillance. How many times do I have to tell the guests to run? Kit Jukes of SocGen, thank you, sir.
I think Chelsea-Brentford's exciting this week.
Thanks, Tom. Check out Bitcoin up more than 3%, approaching 60K, 59,240. A Bloomberg story this morning indicating the SEC could allow the country's first futures-based cryptocurrency ETF. Bitcoin absolutely flying. We'll add to that story a little bit later. From New York, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. It is the latest milestone in a global energy crunch that has seen prices soar. Brent oil futures have hit $85 a barrel for the first time in 3 years. Crude futures have jumped in recent weeks as natural gas prices hit records. While the price hikes raise revenue for oil producers, they risk slowing down economies just emerging from a pandemic-driven slump. Now, it is a watershed moment for the cryptocurrency industry. Bloomberg's learned that the Securities and Exchange Commission is poised to allow the first U.S. Bitcoin futures ETF to begin trading. Unlike Bitcoin ETF applications the SEC previously denied, the proposals by ProShares and Invesco are based on futures contracts. They were filed under mutual fund rulings. In China, there are more signs of concern about contagion from the debt crisis at property developer Evergrande. Beijing is now loosening restrictions on home loans at some of its largest banks. They have been told to speed up approval of mortgages in the last quarter. The UK may suspend restrictions on foreign trucks to help with the massive supply chain disruption. Proposals would allow foreign truck drivers to make an unlimited number of trips during a 2-week period once they enter the UK. That could potentially facilitate thousands of extra deliveries. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Essa população é uma população importante, uma população que frequenta a escola também, né? Então é importante que eles também estejam protegidos para o coronavírus, evitando assim a transmissão.
Eu estava esperando muito por essa vacina. Desde o ano passado eu estava torcendo logo para poder minha vida logo voltar ao normal, que eu quero logo voltar para a escola, eu quero voltar a sair com meus amigos, eu quero sair, eu quero voltar à minha vida normal. Foi toda administrada.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
When you look at technology, how should we be looking at big banks and technology?
Technology is our friend. So it's helping us transform the bank fundamentally. And in fact, we're speaking, I think, as we speak, to our shareholders around what we've done and how we've transformed the bank. We also see technology and technology companies as partners. So some
Not
of our
rivals.
You know, we know that there are big parts of what have been our business historically that will be absorbed into convenience platforms. And by convenience platforms, whether that's Amazon or Facebook or Alibaba or Tencent or something like that, those are platforms that are just very convenient for people to conduct their day-to-day financial affairs. And it'd be very difficult for a bank to compete with that. Now, in some cases, I'd say, let's say in Africa, we are setting up a competing platform to the convenience platforms. And we're working with technology companies and mobile telephony companies and others to create a platform of our own. But for the most part, we're going to be playing on somebody else's platform.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
There's always a balance between the free speech and being responsible and taking down content that we think could lead to some kind of real-world harm.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
While I do think that there is some probability that this will naturally dissipate over the next 6 months. I wouldn't say that that's such a strong case that we can count on that happening. I would put 50% probability on the dissipation story and 50% probability on the persistent story.
The man from St. Louis says it's 50-50. The St. Louis Fed President James Bullard from New York City this morning. Good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro. Your equity market shaping up as follows this Friday. Heading into Friday, poised for a second week of gains, up 15 on the S&P, advancing 1/3 of 1%. There is a lift in this bond market. Yields higher by 3 basis points to 154.41. There's a lift in the commodity market too. Commodities higher. Crude rallying up 0.9 of 1% to $82.03 on WTI. On Brent, we had a little look through 85 for the first time in a long time. You've got to go all the way back to 2018. A little bit of news. I'll let you decide if this is news. Mike Allen over at Axios having a chat with a White House official, telling him that, quote, with Democrat lawmakers on the final shape of the President Biden's Build Back Better agenda, talks are accelerating. This progress means we can conclude negotiations soon. Tom, is that news? Does that advance the story? I'm not so sure.
I think it gets you to the Sunday talk shows, and we'll see where we go from there. Vallier goes the other way this morning. Greg Vallier at AGF saying there's some huge problems here, John. In his summary note, his liberals will cave. There's no other way he puts it. Senator Sanders is going to blink and bring it on down. Anne-Marie Horton keeps score in Washington and joins us now, our Washington correspondent. Mansion. There is a senator from Arizona, of original Green Party member, I guess past progressive and liberal, with a changed tune over the years. Senator Sinema says we're not raising taxes. How does that play this weekend in your Washington?
Yeah, and there are reports that juxtaposition to what Axios is saying is that yesterday the report said Sinema wants to hold hostage that hard infrastructure package. No, excuse me, reconciliation. She's very annoyed that hard infrastructure has not gotten a vote. There's a great piece this morning, Tom, in the New York Times, an opinion saying that, is she really a Democrat? This is what drives Democrats a little bit of the frustration with Kyrsten Sinema. She doesn't negotiate in public. Where does she exactly stand? But the White House does say there have been good faith talks in her. But the thing, we know what Joe Manchin thinks, right? There was that letter that circulated the Senate. We don't exactly know where her mind is. We just know that she's closer to $2 trillion than 3.5.
Into this weekend, staggering into the end of October, in November, how still attached are these two bills?
At the moment, they're very much so.
Still attached.
Yes. And that is what happened when the president made his way to Congress. He basically had to side with the progressives. The progressives in the House had the numbers to hold back hard infrastructure. Now, things can potentially change as we go to October 31st. Speaker Pelosi created this deadline. In that deadline is funding for highways and transportation and railroads. That funding is in the hard infrastructure. So if they don't pass it, they have to do another 30-day, 60-day allowance for that. So that is potentially one way they could potentially try to get hard infrastructure through. But for the progressives, there has to be a framework on what goes in that reconciliation package.
And I still have a mystery on this. Frame the leadership of the progressives. Is Speaker Pelosi part of the leadership of progressives?
She's supposed to represent the entire party, right? So she is dealing with two sides of this party.
She's truly straddling the party.
She has to. She has to. How is she going to get the votes if she doesn't talk to both sides? But clearly, she's trying to go down the middle of what is a very progressive left and a more centrist, moderate right to her party.
And Marie, let's get into the meat of this bill. We've heard that there aren't that many details. However, there are broad platitudes that are being brought out, in particular having to do with healthcare, having to do with childcare. Where are the areas for negotiation at this point?
I think you hit the nail on the head on what is going to be one of the big showdowns within the Democratic Party, and that is the expansion of Medicare. It's some $380 billion over 10 years, an expansion of Medicare. This is dental, this is hearing, this is vision. This is something Senator Bernie Sanders wants done. The same way the power that Senator Manchin, Senator Sinema have in the Senate, So does Senator Sanders. This cannot get over the line without his support. The problem with this is that you're not going to see the immediate uptick that Democrats desperately need going into the midterms. This expansion of Medicare we wouldn't see till well after 2024. I believe it's 2028. So there are individuals who say, since it's such a chunk of money, since our constituents are not going to feel the benefits of it for years out, when potentially some of us won't be in office, maybe that's where we start trimming some of the funds.
Anne Marie, meanwhile, a lot of eyes, and Tom Keene rightly has been talking about the November 2nd election in Virginia for governor, basically being a proxy for the midterms. If there is no deal struck between Democrats before then, how much could that election potentially color the entire tenor of the negotiations heading into next year?
I will say this is actually starting to become a very big talking point in Washington. Tom and I were out yesterday, and we heard a number of people talk about this. This Virginia governor's race, does this foreshadow potentially the midterms of November? And one talking point in the Beltway, and Tom would know a lot about this being from Boston, is people will compare it to, is this an upset potentially of that senator seat in Massachusetts in 2010? What was going on in D.C. was those debate about Obamacare, and the Democrats lost that seat to a Republican the first time they did since the 50s. And this is the fear and the anxiety of the Democratic Party right now.
And where's the president today, Anne-Marie?
Virginia.
Today, the president will be in Connecticut. He's going to be in Hartford trying to talk about his Build Back Better agenda. Hartford, very interesting, right? Connecticut is definitely a more affluent state. But when you look at the socioeconomics of Hartford versus those that live in the suburbs and transport into Hartford, the president is clearly trying to reach those that live a little bit lower than those in some of the more affluent suburbs of Connecticut.
Anne-Marie, thank you. Bloomberg's very own. Down in D.C., our Washington correspondent. Tom, trying to make some headway here, trying to make some progress. I'm not sure if we're making it.
No, I think it's a ballet, John, and it is a calendar item, and that, you know, we'll stagger into November. I don't really know when this gets settled, John, if it does, of course. But what I know is it's not now. I don't sense any real decision-making going on right now in Washington. And part of it will be the calendar, but part of it will be they will monitor events, including how Mr. McAuliffe does in Virginia.
Lisa, it's going to take some time.
I don't understand how it's being priced into markets at this point. We've got definitely the idea that it could be a boost, but also a detraction from equity valuations with the taxes. The consensus right now seems to be they'll get something done, but it will be offset by higher taxes, and this seems to be what's already baked into markets. So I'm wondering where the surprise is, other than perhaps a shift in leadership in the midterm elections.
Got no idea how you can price anything at this point for next year.
There.
Tom, the opinion right now, the set of opinions is just radically different. The conversation, every conversation, whether it's politics, on the economy, the transitory conversation, it is still so polarizing at the moment.
It is polarizing, John, and I laughed when I first heard this word. Maybe I heard it from you, maybe somebody else, and that is narratives. And I was like, yeah, okay, it's transitory. Except it's become accurate. Everybody's got a narrative. Everybody's making it up out of thin air.
Goldman Sachs' president.
That's my narrative for today.
John Waldron said this earlier this week, Tom. I've never seen a greater divergence between what's defined as transitory and what's being seen day in and day out.
Yeah.
That's the view from Wall Street this week. From New York City this morning, good morning.
That was a nice narrative, John.
Equity futures up a third of 1% on radio, on TV. This is Bloomberg.
China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Live from New York City for our audience worldwide on TV, on radio. Good morning to you all. Here's the price action after the biggest one-day gain on the S&P going back to March 5th of this year. We had some weight to the rally, up by 0.4%, call it 18 points higher on the S&P, advancing on the Nasdaq, up 1/3%, on the Russell, the small caps, up by 0.4%. Your next stop for the earnings, Goldman Sachs at 8:30 Eastern. We get US CPI at around about the same time. Going into that, this is what energy looks like right now. WTI and Brent, switch up the board. Brent Crude through 85, briefly, for the first time since 2018, 84.72. WTI, 82 handle. We've seen that in the past week already. In at around 7-year highs, up another 8/9% The story here, demand is good, supply is a problem, and we're drawing down stockpiles. And when you start to see inventories come down, you start to see prices rally again. You see that in crude, Tom. See it in copper, too, on the LME.
Exactly.
Back through
That's
10K.
right where I wanted to go. Right where I wanted to go, John. This is not just about oil. It's about everything else as well. And as Kitchuk's mentioned, it's this rate of change in commodities. What does that mean come November?
And zinc too, Tom. Did you see the Glencore story? Glencore's cutting back on production because energy prices are so expensive. Zinc to the moon as well. Another one to look at.
So my zinc pills are going to cost more money?
Perhaps, Tom. I'm not sure if that's quite how it works, but maybe. Let's get to the bond market. 2s, 10s and 30s. Shaping up a little something like this. On the week, we closed out last week on 5s, 30s. Just take your pick on the curve. I'll take 5s, 30s. 110 on Friday last week. Back sub 100, about 98 basis points now. So today the curve's a bit steeper, 2s out to 10s, but on the week, it's certainly flatter if you look at parts of the curve like 5s versus 30s. Right. A lot of that's because of the rally we've seen in 10s and 30s at the longer end of the yield curve. Tom, this morning, yields are higher by 3 basis points to 154 on 10s. On 30s, a little north of 2% at 2.05% on the day.
What's going to be your focus on the real yield? Folks, you could see it this afternoon and far too many times this weekend as well. The real yield has expanded out a greater negative statistic, John.
Yes, the conversation is going to be about the rate hike dance that's got pulled forward in the last week. A conversation about how sensitive this Federal Reserve will be to the incoming inflation data, Tom. I think the base case has gone from base case transitory. Okay, the balance of risk has shifted. The upside risk is now an upside risk to inflation. I think the base case has to move now, Tom, not just the balance of risk. And you heard it from Jim Bullard of the St. Louis Fed. For him, it's 50-50 now. At the start of the year, Tom,
I like
it was just the plausible outlook was basically transitory, transitory factors connected to elevated inflation, connected to the reopening. I don't think you can keep saying that as much as you used to, Tom. I think the story's shifting.
I agree. It's a parlor game, and of course, retail sales will be part of that data set. We'll see that at 8:30.
Yeah, and Tom, let's just finish on this. Let's be clear about this. It doesn't mean this has to end in a really, really bad way. it doesn't mean that. It's not from everything's going to be great to everything's going to be terrible. It can be something in between, but ultimately it could mean a Fed that's got to be a little bit more sensitive to this inflation story in a way that maybe they didn't want to be at the start of this year.
John, you're sensitive this morning.
I know, I'm just, you know, I'm just a little bit delicate at this idea of the pendulum swinging from everything's okay to everything's awful, everything's okay to everything's awful, and, you know, things can land in the middle, Tom.
Is there anything you want to tell us? I mean, is it Red Sox,
just, you know,
Houston?
just
What's
not trying to get
bothering you?
clicks right now. That's all.
Okay.
You know.
Margaret Patel's with us, Senior Portfolio Manager at Wells Fargo Asset. Her world will stop for Red Sox Astros. We'll see that later today, and we're thrilled she joins us. Margie, everyone agrees, and certainly in Washington on this IMF World Bank trip, everyone agrees no one has a clue. You've seen this before. What do you do when there's cascading narratives with no underlying theme?
Well, I think there is an underlying theme, which is basically interest rates. The whole bond market is controlled by the Fed. I think they never realized, central banks never realized how much power they did have. They can't control the economy or stocks. They've done a great job controlling interest rates. And so I think that we'll see more of the same. Rates will be much lower than we would think for whatever the nominal rate of inflation is. And there is always going to be an unemployment as an out that they don't have to raise rates or cut back on tapering.
Adam Posen was on fire yesterday, Margie Patel, about moving our expectation of a 2% centered inflation rate higher, not to 4%, but in the vicinity of 3%. If we have trend 3% inflation modeled in, how does that change your investment world?
Well, I would look at companies to say who has pricing power that can pass that on. And the way things look, it looks for most U.S. companies, they do have the ability to pass on price increases like that. So again, I would look at companies with growth and pricing power, and 2%, 3%, our current 6%, that really isn't as important as underlying demand and margins.
Margie, earlier Tom was talking about the narrative, and one way that the narrative shifted this week was that the market seemed to embrace the idea of a more hawkish Fed, of a Fed moving faster than previously expected. We saw this with some of the rate hikes brought forward and still the rally. Do you think that this is ultimately an endorsement and frankly that the market will sell off if the Fed does not act quickly enough?
No, I don't. In fact, you can see what the Fed is going to do is just a very little, very, very modest cutting back on its buying, which is actually positive for the market because the fixed income markets are starved for long duration securities. So I think it's actually a plus, and I don't think it'll have any effect on the economy at all.
So at what point will rate hikes start to crimp growth? Could it potentially derail the equity rally that we are seeing, or do you see that as basically baked in, even if we get 2 rate hikes before the end of next year?
I think the economy is on track to continue to expand. I think the U.S. is going to be one of the highest growth countries in the world because corporations and consumers are in such good shape. We have consumers that have enough in savings that many people don't even need to go back to work. Corporations are awash in cash looking for things to buy. Those aren't the foundations for derailing the economy if the Fed knocks up short rates.
Margie, I want to go back to your exceptional insight there on pricing power. For you and I, it's out of another time. I thought of Phil Correa, actually, of Pioneer, when you mentioned that. Margie, I really want to talk about big tech here. Right now, the street is doing sort of a balance sheet, discounted cash flow yield analysis of big tech, and in a way, marking them down. Does the street have it totally wrong, and they will be the kings of pricing power?
Well, we'll have to see. This is an interesting earnings season to see some of the very high-priced, high growers. Can they maintain that rate to justify their PEs? And so I think that's more important than looking at the discounted cash flow for how you discount future interest rates back to the earnings back to the present. So I think that's very important.
As I mentioned, the venerable Correa of Pioneer living to 100 and certainly someone who invented so much of what we do. Margie, how has the word value changed over the decades?
Well, value has been really trashed, and the whole value sector has so underperformed growth that you'd wonder why anybody would look at value stocks. I think that here the pendulum has swung so far that you do have to look at value stocks or GARPy stocks, because if any sector is vulnerable, I think it's some of the very, very high-priced high growers who lose some of their earnings momentum, and the pendulum will swing back to, say, the industrial sector, the material sector, and we'll see those sectors outperform instead of just the pure growthy names.
What about the bank earnings that we just got? What does that tell you about the earnings season, or has it been more opaque than usual because the banks are not as susceptible to some of the pressures, the margin pressures from higher prices?
Well, it shows you that loan demand is rather muted, whether you look at corporations or consumers, and also a lot of loan demand has been siphoned off by other players, private equity, private debt, other alternative lenders. And so that's an area that, to me, that shows the underlying liquidity of the economy and leaves me kind of lukewarm on the bank's earnings power, frankly.
Is there anything you're staying away from right now, Margie?
No, I think most companies in the U.S. are going to benefit, because I do think that with these supply disruptions, corporations are going to be at the margin, moving back production, increasing capital expenditures. So I think it's really, really bullish for American companies.
Margie, how do you respond to Citigroup's research note this morning? And folks, it's still a shock to see their important equity index named in honor of Tobias Lefkovich as the Lefkovich Index. It's so sad that he died. Margie, the Lefkovich Index says we're going down. There's a huge likelihood of caution, maybe not gloom. How do you respond to the caution right now?
Well, you know, Tobias has been saying that all along, that he was very, very cautious on the market. I personally think it's premature, because all of our corrections have been really caused by the Fed over-tightening. And to me, they clearly are telegraphing they aren't going to do that. They're going to keep the market high and use the labor market as an excuse, or transitory inflation as an excuse. So I think they may be right, but I think we have to push it out way into 22 at the earliest.
Margie, thank you. Wow. As always, Margie Bittar there of Wells Fargo. Priya Misratom of TD sharing that view. She said recently the market is betting the Fed will be forced to hike soon. Yeah. We don't think so. The Fed will be reluctant to call this inflation persistent, so they won't react. That's where the debate is right now. And Tom, this week, I don't think we've resolved anything.
That was bottle that, folks. What you just heard there, whatever your belief on the markets, Margie Patel there was absolutely lights out. And John, so importantly, you link someone managing equity and bond dollars over to Priya Misra trying to parse the strategy, making the argument ever stronger.
Priya's running the rate story. And Lisa, that's the conversation at the moment. On the one side, there are people who think rate hikes have been brought forward over the last several months. Others who think the Federal Reserve will keep on track, keep looking through it.
The consensus right now is that they've brought rate hikes forward. And this, I think, the Fed meeting minutes, we didn't talk about enough, that they basically said that they plan to end their bond purchases by the middle of next year. This would indicate they'd be ready to start hiking rates. They have not done a good job divorcing the taper from the rate hike, and they still have that task ahead of them.
I don't think we need to talk any more about Fed minutes, Lisa.
I think we need to have a whole session.
Any more about
I think we
Fed.
need a special on it.
I don't think so. I think I'm totally exhausted by this already, and we've got several months of it still to go. Can't wait, Tom. Yields
several
on
people
twos,
on surveillance would like me not to come
points.
home.
Tens, 154.41. A couple familiar with the story.
Few missed me in New
Indicate to
York.
us that he was not missed. In the bond market, yield time by 3 facts. We can keep going with this. We've got to go. 154 on tens. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Advisors to U.S. regulators say that booster shots of Moderna's coronavirus vaccine should be given to older people and those at high risk of the disease. The booster is half the original dose. The FDA panel says it should be given at least 6 months after the initial vaccination. The Texas abortion ban will stay in place at least until a hearing in December. A federal appeals court says it will keep a trial's judge's ruling blocking the law on ice until the issue is taken up in a related challenge. Texas bans abortions after about the 6th week of pregnancy before most women realize they are pregnant. Amazon has appealed a record $865 million fine over the European Union's tough data protection rules. In July, regulators in Luxembourg ruled that the company violated rules through its processing of users' personal data. Amazon has denied there was any